Alongside Shauna Smith, this is Yahoo Finance's flagship show, The Morning Brief.
Let's get to the three things that you need to know today.
Strike! 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 Strike!
More than 30,000 Boeing workers are walking off the job after overwhelmingly rejecting a contract offer that included, among other things, base wage increases of 25% over 4 years. The union president of the local district saying that they'll have to go back to the bargaining table.
This is about respect, this is about addressing the past, and this is about fighting for our future.
The work stoppage will halt production of the company's aircrafts. This is the first strike at Boeing in 16 years. The last one, that lasted for 52 days.
We're also tracking a mixed AI picture this morning. Adobe shares falling on a weaker than expected sales outlook. Investors were hoping to see stronger evidence that the company's AI tools are generating cash. And on the other end, you've got Oracle shares on the rise on an upbeat long-term revenue forecast, a bullish signal for the company's cloud infrastructure business.
And stock futures rising ahead of the open, on track for the fifth straight day of gains. The Nasdaq heading for its best weekly performance in 10 months. Wall Street is looking ahead to the Fed's next policy meeting, where the central bank is largely expected to cut interest rates by 25 basis points.
Our top story, Boeing workers are already out on the picket line early this morning. You're looking at pictures of employees protesting outside the company's factory in Renton, Washington. 95% of more than 30,000 union members voted to reject a tentative labor agreement and go on strike instead. The company's first in 16 years.
Boeing has to stop breaking the law, has to bargain in good faith, and we will be back at the table whenever we can get there to drive forward on the issues that our members say are important. Congratulations, machinists.
Strike! 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 Strike!
Shares of Boeing are under pressure this morning. Here with more reaction, we want to bring in George Ferguson. He's an analyst at Bloomberg Intelligence. George, it's great to have you here so very early when we're trying to evaluate just the financial impact that this could potentially have on Boeing. But how significant is this strike to Boeing?
It's extremely significant, right? So, excuse me, Boeing's second half recovery is really built around delivering a lot more 737s, getting up to about 8 a month by the end of the year. It's their money-making airplane, best cash generator, best profit generator. So to have deliveries get shut down on that is really problematic for their financials.
George, what type of difference do you think will ultimately come through in these negotiations? I mean, from what was already offered by Boeing versus where they might have to come up a little bit in the package that they're putting together?
Yeah, so I suspect that the machinists are looking at the agreement at Spirit Aerosystems, which is sort of mid-30s kind of increase. And my guess is they'll go after more pay. I also suspect that they're looking at the commitment to build the next airplane in the Pacific Northwest. The way the commitment was written, Boeing sort of guaranteed to the union that they would build that airplane in the Pacific Northwest if it was launched in the next 4 years. I suspect they would want maybe a bigger commitment on that. They want a commitment to launch the next 737, the 737 successor, whenever it gets launched, to build it in the Pacific Northwest. That would ensure union jobs on the most important program.
George, when it comes to the numbers here, 94% of members voted to reject the contract, 96% voted to go on strike. I bring that up because what is this, do you think this signals about how long this work stoppage could potentially last for, given the fact that so many of the union workers were opposed to it?
Yeah, I mean, clearly the rank and file is not happy, right? I think it's just a function of a lot of the problems they've had at Boeing over the last number of years. I think Boeing's really been sort of squeezing the union over the last bunch of years to try to improve financials. And I think they get a sense now for what their value is to the company. As far as how long it means, how long they'll be out on strike, I suspect it means Boeing needs to give ground here. But the way I look at it is that Boeing needs the workers right now more than the workers need Boeing. And so I don't think it's going to be a long strike, because I think Boeing's going to have to go back and make their offer better.
And so what type of downstream impacts would it have if Boeing didn't ultimately net out an agreement here in the near term versus a more extended strike here, given the backups that we've already seen in some of the deliveries and production?
Yeah, so I mean, the way Boeing's playbook has been to date is that they had their suppliers building around a 31 rate while they're trying to ramp to 38. And so, if you do some math on that, at some point, Boeing will absorb all the inventory. They've got like $85 billion in inventory on their balance sheet. If this persists, at some point, they'll have to tell suppliers, stop delivering, right? And so that'll have ripple effects through the aerospace supply chain. There's a lot of smaller companies that may have difficulty surviving at a stoppage or lower rates. And on the airline side, the airlines that have taken a lot of deliveries so far this year are Southwest, Alaska, Ryanair, United. Those are the ones I expect to be most impacted on deliveries.
And what is the time frame that, from your assessment, you would perhaps think that it would take for us to get to that point?
To impact deliveries?
Sure.
Yes. I would say impacting deliveries, you're going to know within a week, right? I just don't see management teams going down there and getting that many airplanes completed and out to customers. So I think within a week, you're going to see impact there. Supply chain, I think they'll let that go a little longer. I think they could let it go, who knows, even a month. But they can't burn a lot of cash here, right? Boeing has a bit over $10 billion on the balance sheet. I think it's 11 something. We think they need about 10 to run the company. Probably cash burn in the third quarter already dipped them below that level. They may need to go back to capital markets. They need to go back and raise either equity or debt so that they can shore up their finances. Debt holders won't like that, right? Their credit rating's under pressure. Equity holders never like being diluted. And so I think that means that Boeing has to, again, within 2 to 4 weeks, probably, if they don't look like they have a resolution, shut down supplier deliveries so they can really stem cash burn.
George, certainly a tough start for Kelly Ortberg there at the helm. I guess my question is, do you think he has the confidence of shareholders in order to reach a deal and reach it very timely before we see that significant financial impact?
Again, I think Kelly Ortberg is so early to this that he's not that much of a factor. I think the machinist really looking past the fact that there's a new CEO. They're thinking just longer term economics for themselves. And shareholders, I can tell you, from a person that's focused on Boeing's financials, can't really see much of an effect from him either yet. So I'm not sure he's much of a factor here.
All right, Boeing releasing a statement on the outcome of the vote here, writing, quote, "We remain committed to resetting our relationship with our employees and the union, and we are ready to get back to the table to reach a new agreement." It's a story we are going to continue to follow here at Yahoo Finance. George Ferguson, always great to have you. Thanks so much for hopping on with us this morning. Let's turn to the software space. Adobe disappointing the street yesterday after the close with a fiscal fourth quarter forecast that fell short of the street's expectations. The outlook fueling some fears that the software company's AI investments aren't paying off as quickly as investors would like. We know that has certainly been the focus here for investors when it comes to Adobe's results over the last several quarters. So the issue that the street is having here with these results, a lot of that has to do with the fourth quarter guidance, and it's really overshadowing some of the beats that we saw in the most recent quarter. They want Adobe to prove that it can make money from all the new AI tools, but there are some concerns about the timeline of that. And then I think, Brad, that coupled with the fact that there are so many startups, smaller players within the space that are doing all they can to win and kind of gain some of that market share from Adobe and some of its other larger peers within the space when you talk about Workday, when you talk about Salesforce. So that, of course, is adding, I think, to some of the pressure on the stock today.
Yeah, you hit the nail on the head with regard to the competitive pressures in the AI space here. Also, you got to think about the fourth quarter more broadly and how it sits within the context for this company here. The Q4 guidance that we've seen as well for net new digital media annual recurring revenue, it is the lowest sequentially for this quarter, and that is adding on to some of the pressures that investors believe to be a part of the story. And then additionally here, there are some larger questions about the growth and the sustainability of that growth into fiscal year 25. Let's remember what type of AI features are really going to be positive for for Adobe and how this plays out for them. When you think about going into a platform, whether it be on a corporate or kind of a enterprise model, or whether it be on an individual basis, it's really coming back to this prompt, the query, and then the output there. And for them to get this right, it really relies on being able to have inferential type of models that have been able to access or at least scan so many different other creative pieces, so that you could then, Shauna, go into an Adobe Cloud or an Adobe, to the extent that people are using some of the image generation tools for AI, which we know is already something that people are trying to safeguard against, is you could go in there and say, hey, create an image of Brad on a Loch Ness Monster swimming through the Serengeti or something like that. And it would generate something. I mean, look, people can dream. So at the end of the day, that's what we're thinking about, and how quickly they can actually bring that to fruition and have it be as accurate as they intend. And then the monetization on top of that. What is the value that people are willing to pay for it?
Yeah, Brad, those are great points. And I think when you compare, especially some of the action that we're having in the pre-market today with the losses here in Adobe, and square that with the gains that we are seeing in Oracle, they updated their guidance last night. That stoked some confidence within the stock. You're looking at a gain of just about 6% here in the pre-market. The bullish revenue targets for 5 years out. So they were much expected, the bullish targets here for fiscal year 2026. But I think what's really grabbing the street's attention is Oracle's 2029 revenue targets. KeyBank out saying that it matched the bullishness that the company has been coyly hinting at for a number of months now. So you talk about the companies that are able to capitalize on some of that momentum within AI. We are starting to see a clear picture of the winners and losers. Yes, Adobe has a lot to be encouraged about. I don't think it's anything like people are saying that they're falling behind when it comes to the AI race right now. But I think that at least when you're comparing the two moves here this morning, when you take a look at Oracle's guidance here for 2029, it is certainly very encouraging to the street.
Yeah, absolutely. And we were talking yesterday about this too, just with regard to how Oracle is going to be able to secure, and continues to secure, we should say, key partnerships that might make them one of the best software plays for AI and for generative AI. You think about the data sets that companies like Oracle, companies like SAP have, or Salesforce as well, how they're able to leverage the data sets that they do have, or their clients do have, and wanting to be able to, same case here, query and get an output, and make sure that you can layer in different customer relationship management on top of that, and all of the other enterprise resource planning tools that they had already had, but just make it that much quicker and the access points that much more favorable for that portfolio client base, and then upsell them on some of those new tiers as well. That's where Oracle has really proven that it's going to try and pull ahead of the rest of them. Partnerships with Amazon, partnerships with NVIDIA, they make that critical for Oracle to be one of those best plays right now. Let's also talk a little treasuries here this morning. Treasuries are advancing as traders debate whether the Federal Reserve will cut by 25 basis points or 50 basis points at its September meeting. Here's what our guests on Yahoo Finance have had to say on the expected cut.
It's going to be 25 basis points in our view. I think it's going to be, there's not going to be any dissents. I think they're all going to be on the same page for the first cut.
Quite frankly, I wouldn't be at all surprised once people kind of crunch these numbers. If you get a little bit of a move back, talking about 50 basis points, given how benign this core PC is looking for the month of August.
And for everyone who's asking for a 50 basis point cut, I think they should really reconsider the amount of volatility that would cause in short-term funding markets. It's just not something the Fed wants to risk.
I think a 50 basis point cut would reek of panic, and it's almost like we're totally behind the curve at this point.
The Fed funds futures are right. The chances are is that it's going to be a 25 basis point cut.
They should go 50, but they're not. They'll go 25 because they're very cautious and they're very much incremental in the way they go about things.
Here with us now to break it all down is FedWatch Advisor, CEO and founder Ben Ammons. Ben, great to see you. Thanks so much for hopping on. All right, so, the size of the rate cut, that's getting debated as of this juncture, even though the CME FedWatch probability at one point this week was looking at about an 83 to 85% chance that, hey, yeah, it's just going to be 25, chalk that up, let's move forward. What do you think we could actually see? Is there still, is this still up in the air for a decision from the Fed, from your estimation?
Well, good morning, Brad. I think first, it's definitely not going to be an AI monster of Loch Ness type of a situation you just described, because, it is a reality of like a Fed having to go down in rates for the first time, right, in a few years. And traditionally, they do that with a conservatism, making one step down with 25, as all your other guests are saying. But for my own estimations is that the probability actually of a 50 is still over 50%. If you actually look further out, there's actually probabilities of around about 7 and 9% for a 75 basis point cut. And those are not, let's say, inconsequential, because if you're looking at the Fed funds rate and accounted for inflation, whether that's headline or core, the real Fed funds, as they say, has risen almost by 100 basis points since the start of the year. So yet we have priced a lot of rate cuts. So there's this big tightening coming in from the Fed passively that the Fed could take away over the next several meetings to support the economy. So technically speaking, Brad, they should be able to cut by 50, even at 75 basis points just on that real Fed funds rate tightening. They're going to go for 25, as I think everybody's concluded, whereby I want to put one more nuance in there that both Powell as well as Waller and even Bostic and others have indicated that there's an urgency on their part, right? They don't want to fall behind what they call the labor curve, meaning falling behind the curve that the unemployment rate goes up too fast, they can't control it. So I do think there will be a debate at this meeting that they should go for more if that were to be the case. So we're getting maybe a repeat of what we saw in 2022, where you start with 25 basis points, and may have to go with more in subsequent meetings.
But Ben, what does that potentially then, does that pose a huge risk for the market if the Fed were to go 50 and make a larger cut or start front loading rates? And I bring that up just because we've talked to so many strategists and even economists over the last several days talking about the fact that risks may be signaling to the markets that the situation or the current economy is in much worse position than what is currently priced in. So if the Fed were to go 50, what does the messaging then need to be to Wall Street?
Yeah, generally people, Sienna, do take that as negative, as in, okay, so they are more worried than we thought they were, and therefore you get the negative reaction. And it may not be necessarily the information about the economy itself, because we all have the same information. It's just within the Fed, there's a sentiment like, well, we are behind the curve, we got to move faster, and that's that negative signaling. But and take the ECB from yesterday, by the way, they did the same thing, right? They didn't signal for October to be cutting again. And you saw the equity market reaction was actually rallying for that same reason, right? They're cautious; they don't have to go as fast. But as I mentioned, I do think there's a debate within the Fed from that other angle. We have already tightened with policy this year by 100 basis points in real terms, and how much is that really slowing the labor market down, so that we're not falling behind if we just go too slow with rate cuts? So if they go for 50, it probably will be a very mixed reaction, if not slightly negative. But I do think that a lot of analysts will come down to this point that I'm making, is that this Fed has room to cut. And so it is actually not unnatural for them to do more because of the effect of real Fed funds on the labor market.
So if we were to see a more aggressive entry point in the cutting cycle, would that signal to you that we actually might be closer to recession than we think?
I actually think, Brad, it signals to me more that the Fed wants to get back to neutral quicker. And basically looking at like, we are in a soft landing. In a soft landing economy, policy is supposed to be more neutral, not tightening, right? And I think that's, to me, what that signals, as opposed to this recession. Because let's face it, like we don't have a recession scenario currently unfolding in any sort of way. All the data doesn't indicate the recession is right here, right now. So the Fed can lower rates. It's then more about how quick do you want to get to neutral. And this neutral rate seems to be estimated around 3%. So there's still some way down till there, right? But it's the idea of like the soft landing is secured by getting back to neutral. It's just a matter how quick. And if you don't want to fall behind the curve, you go quicker. So I think I'm still on the camp of that this Fed goes with 25, but really considers larger steps to be sure that they get the soft landing outcome.
All right, Ben, we have to leave it there. Ben Emons of FedWatch Advisors. Thanks so much for joining us. Have a good weekend.
Thank you.
Coming up, we want to take a look at some of today's top trending stock movers that you need to know on the last trading day of the week. All the details for you next, our morning brief.
Now time for some of today's trending tickers. You can send the QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's start with RH. Shares surging as much as 20% this morning after the furniture retailer reported revenue and profit that topped Wall Street expectations. But looking forward, the company cut its sales forecast for the year, saying revenue will lag demand as it adjusts its assortment. All right, now here's what's really important to know about how they're quantifying or how they're talking about demand here. And I think for anybody who's looking across RH going forward, this is how they're going to be reporting it. Demand is this operating metric that they're using to reference the dollar value of orders placed, and the orders then convert to revenue upon a customer actually obtaining control of the item that they've ordered here, whether it be a couch or overpriced or oversized mirror, the merchandise. And it excludes exchanges and shipping fees. Why do I bring that up? Because they're essentially going to be reporting demand and revenue differently. And so in future reports here, that's how you're going to be looking at this breakout, where demand might actually be preceding some of the revenue before it's actually recognized in future reports.
And that might explain why the street is discounting that just a bit, just in terms of they're not as worried as maybe you would initially see when you see the fact that it could be lagging just a bit on that timeline. But when it comes to, I think more interesting to me is when you take a look at RH and some of the outperformance that we have seen, and we know they have shifted their focus just a bit, but it comes at a time when we talk about the fact that the consumer is under pressure. And the last time I was in an RH, Restoration Hardware, stuff is pretty pricey.
It smells good in there,
I think it does smell very good in there. So I think this also illustrates what we have been talking about here, the gap between the outperformance or the stability and the health of the higher end consumer versus a lower end consumer, and exactly maybe what that tells us about some of the spending patterns, or those that are better positioned to maybe weather a challenging couple of months or couple of quarters ahead, depending on how everything all shakes out.
What they're calling the most challenging housing market in 3 decades that they're operating through right now.
Yeah, and I think it also, Morgan Stanley saying that demand trends are encouraging, but tail risks do remain elevated, and a lot of that having to do with some uncertainty surrounding the consumer. Let's take a look at Moderna taking a hit today, adding to yesterday's losses. Jefferies and JP Morgan among the companies here downgrading the stock on what was announced yesterday, plans by Moderna to reduce research and development spend by about 20% over the next several years. You're looking at extended hours move to the downside of just about 5.5%. The downgrades, of course, coming following that announcement yesterday. Oppenheimer out saying that Moderna is in transition mode. Also went on to say that with research and development, R&D restructuring, Moderna's some of their assets, particularly those in viruses in oncology, will increasingly influence the pipeline and therefore consequently feel more pressure to reach commercialization. So certainly lots of questions just about the pipeline, what that timeline looks like, getting these products to market. So again, it could be a bumpy couple of quarters, to say the least, a couple of years maybe.
Exactly. The analysts behind this saying that they're projecting the launch of these multiple new products over the coming years. However, the 2028 revenue estimate falls shy of the $6 billion targeted to achieve operating cash break even that year. Also, they mentioned it could be challenging for the stock to perform apace with the group. So basically to keep up with the kind of competitive environment that Moderna does operate within. So therefore, they gave it an underweight. So shares right now continuing to, at least pre-market here, be in focus and under pressure. We'll see exactly what this nets out going forward for the company here. Also, let's take a look at shares of PDD as the Biden administration targets Chinese retailers Temu and Shein with new rules to curb alleged abuse of a U.S. trade loophole. Shares of PDD are down right now by about 6%. Of course, they've been heavy in advertising mode, making sure that their subsidiaries, and primarily Temu, looking at how they can make sure that they have a continued expansion more so internationally here. Who could forget this last year's Super Bowl and the amount of ads that were Temu ad? I mean, it was essentially like what Tide was doing a couple years back. Psych, it's a Tide ad. Like, no, psych, it's a Temu ad. Almost every single commercial break, it felt like. So all these things considered, this is going to be a big hit, at least in the near term, potentially, if the Biden administration takes more action curbing some of the availability or the ability for these Chinese digital marketplaces to really grow on top of the client base that they've already secured here in the U.S.
Yeah, and these are crackdowns that those within the U.S., U.S.-based companies have been advocating for, talking about the disadvantage that they are then put at as a result of these loopholes. And it's not just PDD, Pinduoduo, who's falling on this news. It's also important to point out that we're seeing some pressure across the board when it comes to some of those larger cap Chinese companies here. When you take a look at Baidu, that's also moving to the downside here. When you take a look at Alibaba, those shares off just about 1%, selling internationally via its AliExpress site there, JD.com. Also under a bit of pressure here today. On the flip side, those that are gaining as a result of this, Etsy. Etsy shares have been up about 7%, now up just about 4.5%. We know Etsy's management has been very vocal about this, saying that we think that targeted regulation focused on cracking down on abuse may be very appropriate, making that statement before this crackdown was announced. But again, the White House taking some steps to address this. As a result, we're seeing some of those Chinese listed U.S. names under pressure.
Yeah, if you were holding your breath for a Shein IPO for some reason or another, don't any longer. Just kind of exhale.
Keep it right here on Yahoo Finance as you exhale. Coming up, recent volatility in technology, highlighting some concentration risk in the market once again. We will discuss where to fund opportunities in U.S. equities next with Stephanie Aliaga from JP Morgan Asset Management.
All right, we're just seconds away from the opening bell here in the U.S. You're taking a look at the U.S. futures here for the Dow, the S&P 500, and the NASDAQ. We are mixed. The NASDAQ futures, the tech-heavy NASDAQ is down right now by about 0.2%. We'll see what the opening cross holds for us. Here's a look at the opening bell. At the NYSE, you've got Citi ringing the opening bell there, and then at the NASDAQ, you've got MBX Biosciences. All right, great. Bunch of folks on both sides there. You got some funfetti at the NASDAQ here. Why not? It's a Friday. Let's get lit. All right, taking a look at how things open up on the trading day. We begin the day higher for the Dow Jones Industrial Average, flat just barely to the upside here. Let's take a look at the chart just to give you a sense of how we've been faring over the course of this week. I'll give you a 5-day look. Why not? Over the past 5-day period, those 5 sessions were up by about 2%. We'll round that off to the Dow Jones Industrial Average up by about 0.5%, 0.6% to kick off today's trading activity. There you're taking a look at the NASDAQ composite. We're waiting for that to calibrate as of right now, but we were seeing some slight declines, a smidge of decline to start off the trading session, at least as the futures were indicating here. We'll rejigger that in a hot second. The S&P 500, you're still seeing some fractional gains there to start off today's trading activity. Let's get on over to the heat map, though, where we can get a better sense of who's moving, who's shaking, and who's quaking right now. Let's take a look at the NASDAQ NASDAQ 100 first and foremost. Apple, you're seeing that flat just barely to the upside here. It's been a big week for them. Google, we're keeping close tabs on Alphabet. Both Alphabet and Apple embroiled within some of the EU allegations and litigation over the course of this week. And so we'll see what that nets out. It could be a while before we hear. But ultimately, Alphabet here on the day, catching a smidge of a bid. It's up by about 0.5%. And then additionally, taking a look at NVIDIA in the week that has been over the past 5 days, we are up 16% for NVDA. Keep close tabs on that as we move on throughout the session. And lastly, as we always do, we got to give you a look at the 11 S&P 500 sectors. Largely positive. Real estate leading the pack right now. It's up by about 0.6%. But pulling up the caboose, you've got staples down by 0.1%. Shauna?
All right, Brad, still some time to turn that around. Let's talk about some of that volatility returning to the markets this week, highlighting the risk of concentration within the tech sector. Still, valuation remaining expensive. So where can you find opportunity within U.S. stocks? Joining us now to discuss for today's strategy session, we want to bring in Stephanie Aliaga, J.P. Morgan Asset Management Global Market Strategist. Stephanie, it's great to have you. So we certainly have seen the return of tech stocks here this week. We have the NASDAQ. I believe it's on track for the best weekly performance that we've seen in about 10 months. I'm curious how you're looking at the fact that we are seeing technology stocks back in favor.
Absolutely. I think the last few weeks of choppiness have just really underscored one of the maybe unintended consequences of the really impressive performance we've seen in the markets over the last 18 months or so. And that is just that it leaves markets more susceptible to choppiness and just a few individual names. And while the quality and a lot of those tech names that are leading the index is still very, very good, they are much more susceptible to really any misses in sentiment, any dimming in sentiment, and that could lead to some volatility in the markets. So I think it's a really important point for investors to just look at their overall exposures. Where have they gotten a little bit off sides? Do they have the right amount of risk exposure to some of these individual names? And fortunately, now this year, we have this broadening out in earnings growth that is providing a more durable support for the markets that is not just relying on these few individual names.
Where can investors be comfortable with risk in their portfolio? And of course, it depends upon their risk appetite for their portfolio. But where are some of the more stable risk names in the market versus those that perhaps are still needing to prove themselves and prove the valuation that they should grow into?
I think the focus really has to be on quality, because even if tech, we traditionally think of that as perhaps a riskier sector of the markets. In the current market environment, you have a lot of these tech names have a lot of cash on hand, and they're using that to invest in future growth opportunities in R&D and CapEx. But it's not only tech that actually has healthy cash balances. It's other areas of growth markets, consumer discretionary, consumer services, also healthcare, real estate. And it's also not only tech that's investing or that is a beneficiary of all of the major capital investment going towards AI and these AI infrastructure needs. So it's really, I think, looking underneath the hood, continuing to emphasize quality at this juncture and companies that can still do well with a moderating economy.
Talking about a moderating economy, some of the sluggishness that we have seen, especially within the labor market, has sparked this debate about what the Fed should do at the meeting next week. There was a lot to talk about. 50 basis points initially following some of those weaker labor prints. Now on the heels of CPI, more talk about 25 basis points. I'm curious, though, let's first focus on 50. Could that potentially do more harm than good, and why or why not?
We think it could. And the key here next week, and Powell has his work cut out for him, is in getting the messaging right. Because besides the 25 or 50 basis point cut, we're talking about a Fed funds rate that's at 5.25 to 5.5. Meanwhile, unemployment's at 4.3, and now headline CPI 2.5%. The time has come to begin normalizing policy. The debate is around, do they start really small, or do they start just a bit bigger? But the key here is that the Fed begins this easing cycle by continuing to emphasize the confidence and the success in bringing inflation down towards its 2% rate, and just acknowledging that the labor market is cooling. It's time to start normalizing policy, but they're not getting into emergency mode of trying to prevent a recession. That's where the risk is. If they do this and risk markets thinking that they're behind the curve, that could actually create more harm than good with this 50 basis point cut.
And so at a certain point, it's going to come back to what their terminal rate looks like in this cutting cycle as well. So what is the broader cutting cycle playbook that investors would be apt to start to enact right now?
The focus is going to be on the economic data over the next few months and then the next year. Fortunately, when we look at the broader labor market mosaic, as we've been calling it, it still does look like the underlying demand for labor is still healthy. We've just had a lot more workers in this economy that's outpacing the pace of hiring. But earnings growth is still strong. Consumers are still continuing to spend. And so it still looks like a soft landing can be achieved here. And if that's the case, we think the Fed is going to be able to take this more gradual approach to policy easing, which is, I think, what markets are still expecting as well.
And Stephanie, going back to what you said a moment ago here, talking about the broader participation that we have seen within the market, given what we are expecting from the Fed, how should investors then be reallocating or adjusting their portfolios?
I think some of the mixed signals that we've seen in the jobs reports lately, we might continue to see. There is a lot of uncertainties in the statistical, I think, computation of some of those surveys right now, given pandemic distortions. Some of those signals, mixed signals, may just create some more volatility going forward. We're going to need to take a broader lens to appreciating the scope of data. But the good news for investors is that the underlying, resiliency in the economy is still intact. Maybe there's some choppier waters, but if you're making sure that your risk balance, your risk exposure is well balanced in your portfolios, and investors tend to have a bit longer of time horizons than just the next, 6, 12, 18 months, time is on your side, and all of that should hopefully really settle out over that horizon.
For how long do you think corporate earnings can continue to prove resilient, knowing that many of the companies that we've heard from over the course of this earnings season are not screaming and shouting that the house is on fire, but they're saying, okay, this is something that we need to monitor, especially given our own cost inputs right now, plus where the demand environment is actually still willing to spend?
I think the demand environment is going to be really key here. Which kind of consumers are continuing to spend and how much are they? But one of the key, I think, points for me is that the economy counts by dollars and not heads. And even if we're seeing some price sensitivity, and we're hearing that from retailers that are more catered towards the lower income consumers. It looks like affluent consumers are still continuing to spend, and they are also benefiting from this great stock market performance that we've had over the last year and a half. They still have a lot of home equity. They have interest rates that are fixed at their pre-COVID levels or during COVID levels. So there's still a lot of resiliency there, and we think that that ultimately is going to lead at least many parts of, I guess, the equity markets or earnings sectors still resilient in that environment.
Stephanie Aliaga, who is the JP Morgan Asset Management. Thank you so much for taking the time
Thanks for having
with us today. I appreciate it. We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief.
Adobe's sales guidance for its fiscal fourth quarter falling short of the street's estimates, and that's overshadowing the company's top and bottom line beats in its latest quarter. Now looking at losses of just about 10%. That disappointing outlook bolstering some anxiety on Wall Street. The software companies are struggling to make money from hefty AI investments. So here to discuss is Alex Zuckin. He is a Wolfe Research Managing Director and Head of Software. Alex, it's great to have you here. So talk to me about the reaction that we're seeing in the stock this morning. Shares are off 10%. Do you think that's warranted given the beats that we saw in the most recent quarter, but obviously falling short of guidance here for the fourth quarter?
I don't. I think this is an overreaction. I think there are some timing elements where a few deals that were expected to close in Q4 closed towards the end of Q3. I think if you look back at last year, the guidance for the second half is exactly the same as the guidance was last year. And I think that ultimately the company will execute, and you're going to start to see Adobe as one of the best ways to monetize AI investments that you were just mentioning in the enterprise segment. And I think you're going to see accelerating growth and improving margins. And this quarter didn't really change any of those thesis for us. I definitely understand the frustration given the implied Q4 guidance is below where consensus was for a key metric, which is a forward-looking indicator a lot of times to the growth rate. But I don't, it just, nothing changed in the fundamentals in our opinion.
Which of the Adobe clouds needs to see the most significant uptick or just demonstrate continued growth in order for it to pass through to the profit margin for the company?
Definitely the digital media business is the cloud that needs to see the biggest impact from AI monetization. I think that they have a number of different levers to do that with generative credits within the portfolio of Photoshop, Illustrator. I think some of the new launches and innovations they're going to be releasing at Max around the video model, I think that's a pivotal moment to unlock some of that incremental monetization in the enterprise. But I think that's the cloud that investors are really laser focused on to see how generative AI functionality gets ultimately monetized by the company.
Do you think that where do you think they are in that track, in that span of kind of delivering what the market is expecting, not the equity market, but what their consumer base and customer and client base is expecting for what generative AI layered into that digital media cloud should look like?
Yeah, I'll even step back a second. I think all of enterprise software companies are relatively early in that journey. I think they're figuring out how to get it to be useful for the user, how to get it to be repeatable, how to get compliance and legal to be okay with the data that's traversing those models and the outcomes that it's generating. I think of the general pack of companies, Adobe is much further along. I would put them almost right behind Microsoft in their ability to actually show real disruptive ROI to those companies where they can understand how adopting generative functionality within their creative workflow really can increase content velocity and content generation capabilities at a much lower price point than they're used to, as most historically budgets within marketing really are going to the creative agencies. And I think Adobe has a chance to kind of bring that back to bear and really see kind of a win-win situation with customers.
You mentioned the fact just a moment ago that you think that this is a bit of an overreaction. The state of competition came up a few times on the earnings call, something I'm reading a lot about here this morning. How worrisome is that, do you think, not only for Adobe, but some of the other larger software players in this space when it comes to some of those smaller startup rivals that are looking to chip away at their market share?
Yeah, look, I think this is an exciting time in software. There's a lot of innovation happening. There's a lot of capital going into the space. There's a lot of really unique, exciting new players emerging. But I think that this wave of generative AI innovation, there's a lot of benefits to incumbency. I think those benefits rise when you go into the enterprise. I think the ability to already have large contracts that are approved, that are through procurement, that are through legal, that's a big advantage, both from a budgetary perspective, where budgets are not expanding or growing at the rate that some would otherwise want. And so you're looking at how to consolidate budgets, how to do more with less vendors. I think that's an advantage for large incumbents like Adobe. And I ultimately think that some of the bigger advantages that are going to accrue in this age of AI is the indemnification, is the legal protection, is the security that some of the larger vendors can offer, at least even from a perception perspective to customers versus some of the upstarts. And I think that specifically for Adobe is a very unique competitive differentiation that is ultimately in our minds going to compound as they release more and more of these models and in multiple modalities.
Yeah, absolutely. While we have you here, Alex, one of the other companies that we're tracking is Oracle. Oracle, on the other hand, lifted its fiscal 2026 revenue forecast and a lofty outlook looking out to the 2029 fiscal year. The company's optimism coming from its cloud infrastructure unit surged 45% year over year in the most recent quarter that we heard from Oracle. Is Oracle effectively cementing themselves as one of the best ERP plays that is perhaps more of an AI thesis, or one of the best AI ERP plays, as I should have put it a moment ago?
Yeah, look, Oracle is advantaged. I think Oracle is really good at building enterprise class infrastructure. I think they've been doing it for decades on the software side. I think the Oracle database is, supports some of the most mission critical hardened workloads in the world. I think that over time, both the database and the application portfolio, customers are going to have to migrate at least probably the majority of those workloads over to the cloud to take advantage of some of these innovations that we've been speaking about around generative AI. And I think Oracle has done a really good job of building an ecosystem with the other hyperscalers, making it easier for customers to say yes to moving those on-prem workloads into the cloud on any hyperscaler that they chose. I think it was a huge deal for Oracle to talk about AWS as a new partner for them. That's been, something that not a lot of us expected a year ago, even after the Microsoft relationship. And I think they've got a lot of irons in the fire across the entire ecosystem, and kind of similar to Microsoft, advantages in one part of the stack start to diffuse into other parts of the stack. And for Oracle, again, not that dissimilar from Adobe. What that's translating to is accelerating growth with improving profitability.
Alex, what do you think? Two quick ones here. The financial impact from the deal with AWS, and then moving on, what do you think this then signals about the potential for future partnerships here with other larger players within the space?
So I think that the AWS partnership is a big deal. I think mostly because customers that are AWS customers are now going to be able to use funds that are allocated to their hyperscaler bills on workloads that are on Oracle. I think that's a big deal. I think the fact that it's now fully multi-cloud meaning that the same service is available on AWS, on Azure, on GCP, gives customers, again, more faith that they can choose Oracle and know that no matter what future relationships they create with their hyperscaler partners, at least that relationship is very stable and therefore is predictable and scalable. I think in terms of other partnerships, look, I don't know who else is left, quite frankly, on the hyperscaler side. I'm sure that there are probably interesting application partnerships that they could strike, and AI partnerships that they could strike with some of the emerging foundation model vendors. But I don't know if that's in the cards in the short term.
We will see. Alex Zukin, Managing Director and Head of Software at Wolfe Research. Alex, thanks so much for taking the time here with us on this Friday.
Thank you, guys. Happy Friday.
Same to you. Sticking here with all things AI, the new tech potential has helped boost investor optimism around the Magnificent Seven over the past few quarters here. But Bank of America forecasts they see the market's growth broadening out in the months ahead. Catalyst co-host Madison Mills takes a look in our chart of the day. Hey, Maddie.
Hey, Brad, thanks so much. So it's really interesting. This is the idea that the relative earnings of the names outside of the tech sector are going to start to pick up as those earnings within tech. Maybe that gas is getting a little bit taken out of the tank here. I want to pull up our chart of the day behind me here for a second so that I can take a look for the first quarter of 2024. Bank of America estimating that over half of the EPS growth came from those Magnificent Seven names. Now, if we can move forward in the chart here, we can look ahead to the second quarter of 2024 here. That's the quarter that we are just wrapping up. You can see a little bit of an uptick in those other forgotten 493, a little bit more earnings growth coming in from those names as Magnificent Seven just starts to stall ever so slightly, but still 36% growth, not so bad. And then when you take a look fast forward a year from where we're at right now, you see even more growth in those 493 names and a little bit less in that Mag 7. So what is the takeaway here? Well, this morning, Federated Hermes saying that the relative earnings of the tech sector compared with everything else, if that really does start to stall, that's kind of the ground of the bull market that we've had since those October 2022 lows. So that could be concerning for the path forward for this bull market. Having said that, guys, what I think is really interesting is that this is kind of exactly what the market's been asking for, right? We've been so concerned about the rally being concentrated in just a handful of seven names, and now we're finally starting to see growth outside of those names, and now the market's getting jittery about that. So I think what's interesting to note is, as you can see behind me, that number, that growth overall is declining, and it is difficult for tech to maintain this stellar record of growth year over year, quarter over quarter. So of course, as you do see that growth kind of stalling a little bit, there are questions about the path forward for this bull market, Shauna.
Certainly lots of questions there. All right, Madison, great chart. Thanks so much for breaking it down for us here. Keep right here on Yahoo Finance. Just about 23 minutes into the trading day, you're still looking at gains across the board. The NASDAQ on track for its best week that we've seen in 10 months. We're going to have more on today's recent moves when we come back.
Time for our Stocks in 30, a look at today's trending tickers in 30 seconds or less. Let's kick it off with Wells Fargo. The Office of the Comptroller of the Currency, known in your hood as the OCC, found the bank's protections against money laundering and other illegal transactions were too lax. The agency did say that Wells Fargo is working to address these issues and declined to fine the bank. We also have a statement from Wells Fargo on this agreement as well here, essentially saying that the agreement's requirements, including enhancements to AML and sanctions risk, anti-money laundering is the AML, sanctions risk management practices, and then obtaining the OCC's acceptance of the bank's program as well. They're looking to address the substantial portion of what's required here in the agreement.
All right, let's take a look at another trending ticker. Activist investor Engine Capital taking a 4% stake in Upwork, the freelance marketplace. Engine will push Upwork to revamp its board and fix what they call foundational issues in the company. You're looking at shares now up just about 6% here for Upwork since the start of the year. You're looking at losses of more than 30%. And some of those foundational issues, that's what we really want to get into. Engine is pushing for the company to simplify the platform, cut costs, also grow its enterprise business. They also talk about the fact that there has been a number of changes within management over the last several years. They stopped short of calling for the ouster of the company's CEO, Hayden Brown, but they did go on to express some frustration with how many different managers have been in place here over the last couple of years, talking about the fact that Brown has actually had 3 CFOs in 4 years.
Yeah, and one of the other tickers that we're tracking here today, finally, watching semiconductor designer ARM as Raymond James initiates coverage on the company with an outperform rating and a price target of $160. We're keeping close tabs on shares here on the day. Raymond James essentially saying that Gen AI, that's the big tailwind behind ARM's CPUs and data centers. Also saying that ARM's not directly participating in the data center AI accelerator market, but they see that as a good possibility that could play out longer term.
All right, coming up, we're getting a fresh read on the consumer with the University of Michigan's consumer sentiment data. That's out at the top of the 10 a.m. hour. We're going to have that and more when we come back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day, we've got 3 catalysts for the market: consumer sentiment, Boeing workers on strike, and calls for a Fed rate cut.
That's right. Let's get to the University of Michigan consumer sentiment data coming in just above expectations here at 69. That is above the estimate. And we also have year-over-year expectations for inflation falling just a touch, indicating that consumers might be feeling a little bit better about the economy as we head into that Fed meeting next week.
And Boeing union workers are on strike for the first time in 16 years. Shares of Boeing are falling today on that news.
And 25 or 50, the Fed's on track to cut rates next week. We're going to prep you for the market's reaction.
Let's kick it off with the breaking news that we have. Consumer sentiment released just moments ago, coming in above expectations. The print was 69. We were expecting 68.5, so rising there. And that's not all. Expectations for the index also coming in better than expected when you take into account what we are expecting going forward. Expectations index rose to 73 versus 72.1 last month. Also expected change in median prices during the next year. That actually fell to 2.7% after 2.8%. And that, to put in perspective, is the lowest reading that we have seen in nearly 4 years, going back to December of 2020. So we talk about the fact that consumers are slowly coming around, maybe feeling a bit better as to where we are right now for the Fed's fight to tame inflation. Although not great, we have seen a bit of an improvement here recently.
I think it's great you point out that this is the best reading since December of 2020 on that inflation expectation handle, coming in at 2.7%. It's also the best headline number since May. So certainly some optimism that we were sensing from the consumer here. But let's dive deeper into the market reaction to this data. We've got Young Ma, the Chief Investment Officer over at BMO Wealth Management, joining us now. And Young, it's great to have you on the show this morning. So I'm curious, I mean, this consumer sentiment data obviously coming in better than expected. I don't necessarily think it's going to change the game for the Fed next week. So I'm more interested in getting your take on whether or not 25 or 50 is going to be worse for the market action next week. Which do you think traders will be more disappointed by?
Well, thanks for having me on. It's great to be here. It is at least nice to see that consumer sentiment bouncing up a bit. I think that's reflective of what's still a relatively stable job market. And you do have inflation coming down in various areas, and especially oil prices and gas prices coming down. I think that filters into it a lot. The Fed is going to be looking at a variety of factors. It's probably, we think, leaning toward a 25 basis point cut, although we do think in the current environment, 50 would be very well justified given how much inflation has come down, notwithstanding the recent CPI and PPI readings. We still think that downward trajectory is intact. And also, we are seeing some softening of the labor market on the margin. The market's reaction, if we just get a 25 basis point cut, it's going to then depend on what the messaging and narrative is. If the Fed and Chair Powell sounds especially dovish and just has a 25 basis point cut, I think the market would take that in stride. But if we don't have that type of dovish messaging and only get a 25 basis point cut, I think there could be a perception that the Fed is behind the curve here. And the next Fed meeting isn't until November after this upcoming September one. And there's a long runway until then, a lot of things that could happen in the labor market in terms of potential softening. So we'd like to see a 50 basis point cut, but probably leaning a little more toward 25 being the likelihood.
So then, Young, what does that tell us? I guess, does that then, from the fact that, or at least from your view, that the Fed is behind the 8 ball when it comes to cutting?
We do think the Fed is a little bit behind the curve here. Inflation's been coming down well. The Fed, in its discussion of being data dependent, has really focused on backward looking data and rather than some of the forward looking indicators of wage gains moderating and some other factors in the labor market that look like they're softening. So we do think a 50 basis point cut is justified. And we think that as we go throughout the rest of the year and into 2025, the Fed is going to continue cutting. So the trajectory is ultimately what's most important. But if we're thinking about short-term reaction, it's going to depend on the magnitude of the cut and how much the Fed's messaging leans dovish. And we're also going to get new economic projections out. So that's going to be very important as well, that the market focuses on what the Fed is thinking for that trajectory going forward.
Yeah, Young, a quick follow there. You talk a lot about the messaging that the Fed needs to have or should have or maybe is necessary here, what the markets wants to hear. They do cut by 25, but what if they go 50? Because then the messaging, you could argue, would be even more important because that might incite some panic within the market.
We don't think it will. We think that's a misplaced idea. Maybe very short term that could happen, but we do think the underlying economic factors are stable. And really right now, the problem is high interest rates. So if we think about other times in the rate cutting cycles, if we go back to 2001, 2007, 2008, the Fed was cutting rates to try to counteract other problems in the economy. Right now, the primary problem in the economy is actually higher interest rates. So by cutting rates, we think that's a direct effect to solve that problem. And we think ultimately it's going to be taken well by the markets, even if there's a slight knee-jerk reaction the other way. We think there's no reason for panic.
So Young, super quick, and then I'm going to move on to tech with you before we wrap. 25 or 50, which is worse for markets next week?
I'd say 25 is worse. We'd like to see 50 because we think it's warranted. And if we only get 25, there is a possibility of that narrative of the Fed being behind the curve of just setting in a bit too much.
All right, 30 seconds here. The tech sector. How bullish will rate cuts be for tech as we move into the second half of this year?
Well, we like tech, and we think there's been a nice pullback, some nice entry points were to be had there. And we think as we go into 2025, that the tech sector, both because of interest rates, but also because of continued spending, AI productivity gains, we think there's still a very long runway for the tech sector here.
All right, Young Yuma, always great to talk to you. Thanks for joining us here. Chief Investment Officer at BMO Wealth Management US. Thanks so much, Young Yuma. Turning to a big story we are watching today, and that's the Boeing strike. Taking a look at shares under a bit of pressure, over 30,000 union workers voting overwhelmingly to reject a new labor contract. Boeing workers across the West Coast stopping work and walking out for the first time in 16 years. When you take a look at the downward move in the stock, falling just about 2.5% today, down almost 40% this year as the company also faces scrutiny over safety concerns. Let's talk about this with Mike Boyd. He's the president of Boyd Group International. Mike, it's great to have you on again with us. So let's talk about the fact 94% of members voted to reject the contract. 96% voted to go on strike. What does that then tell us about maybe how long this strike could last?
Well, we don't know. I mean, it depends on what they're striking over. But when you had, the people running the IAM who put this deal together, they didn't fall off a turnip truck. They know labor relations. What this says is that they're going to have to go back to the bargaining table and be a whole lot harder than they were before. It may be just a couple of minor issues that'll fix it, but where you have, 96% saying we want to go on strike, 94% rejecting the contract their union negotiated, this may be a long situation.
It might be, especially because if you're a union worker, you're probably thinking no better time to strike than right now, given the problems that Boeing has been experiencing. From your point of view, do they have kind of all the chips in their hands?
Well, yeah, they do. There's no question about it. Boeing has its back against the wall in terms of product. They have the back against the wall in terms of public perception. They have the back against the wall in terms of markets. And I think, the union says, look, we want something more, and they do have a lot of leverage to get it. The question is, the new gentleman running the place has a lot more on his plate than just a strike. There's a whole lot of other things he has to deal with. This doesn't make it any easier.
So then does that make it more likely that maybe they will concede to some of the wants of the union workers, given the fact that they already are under significant amount of pressure, given the stacking number of challenges that Boeing's facing?
Yeah, I think right now the cards are in the union's hands. But again, Boeing has so many different problems facing it that in the near term, they're going to have to try to settle this. Because keep in mind, this is an economic hit. There are a lot of suppliers out there across the U.S. and internationally that are, being told this morning, don't ship any more parts. And they've already gotten that message earlier with the slowdown on the 737 and 787 programs. So Boeing, its entire infrastructure, its entire founding, if you will, right now is under severe stress. And I think the thing is they're going to get forced to try to settle this as quickly as they can.
Mike, is this a nail in the coffin for the company then?
I would hate to say that, but, is this another Curtiss aircraft that in 1940 was the biggest in the country and 8 years later is out of business? I don't know. They've not invested in new airline product. That's going to come back and bite them. That's their biggest problem. They have nothing to replace the 737, which is probably maybe, one upgrade too many already. So if they're going to stay in this global business, they're going to have to figure out what to do. And that means investing in not stock price or not games, but a new product.
Right, but it's only day one of the strike. So when we put this in perspective for our viewers out there, at what point should they get a bit more nervous?
I think right now this is where it is right now. I think right now Boeing has to settle this strike like as quickly as they possibly can to focus on other things. That means, the folks at the IAM, they hold the cards.
I am curious from a shareholder perspective, how long, we've had some Boeing shareholders come on the show and talk about this idea that they don't have competition. So Boeing's bound to come back, almost this idea that they're too big to fail. How long does that argument continue to hold water in your view?
The argument is there is no other manufacturer other than Airbus. The lead sleds being put out in China will never get into the global marketplace. So there's only one game in town, that's Airbus, and Airbus has invested in a new platform by buying the C-Series airliner from Bombardier in Canada. So they are way ahead of the curve when it comes to Boeing. But is Boeing too big to fail? I don't know. The fact of the matter is they don't have a new product beyond the 737. That is their number one problem in the business.
All right, Mike, we got to leave it there. Mike Boyd, always great to talk to you here. Boyd Group International President. Thanks.
Thank you.
Let's take a look at some of today's market headlines. Just about 45 minutes into the trading day, this is sponsored by Tasty Trade. Kicking off with a look at the major averages. We want to take a look specifically at the NASDAQ, talking a lot about the tech trade here. You got the NASDAQ up just about 0.5%, NASDAQ 100 on track for its best weekly performance that we've seen in just about 10 months. You've also got the Dow, the S&P, and the NASDAQ all on track for weekly gains. As it stands right now, the Dow is up just over 200 points. Flipping over to a look at Treasury yield, certainly some volatility that we've seen this week on the back of the most recent econ data, some reactions to the jobless claims numbers yesterday and the most recent reports that we got on inflation. Taking a look at the 10-year yield today, pulling back just a bit, off about 2 basis points at 366.
All right, I want to check on the gold space here for a second, because if you take a look at gold, it is still up today after breaking out to a record all-time high after yesterday's market action. And this is particularly interesting given that gold is typically seen as a haven trade, but we are seeing good news elsewhere, right? We had that consumer sentiment number coming in better than anticipated, folks feeling a little bit more optimistic about the state of the economy. You've got markets pricing out that 50 basis point rate cut, markets pricing out geopolitical risks. You have the market rallying today, and yet you've still got gold continuing to hit all-time highs throughout this year. So the big question, is the gold market trying to tell us something that we should potentially be worrying about, or is this just some of that diversification that the market has been looking for?
And we certainly are seeing investors look ahead to next week's Fed meeting, so we will see what we get. Keep right here on Yahoo Finance. Much more of your market action ahead. You're watching Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time now for our trending takers. Let's kick it off with Uber. Shares getting a pretty big boost today after announcing an expansion of its partnership with Waymo. You can see those shares are up about 6%. Pre-market, they were up over 8%. Now, this comes as these two companies plan to bring driverless taxis to both Austin and Atlanta starting in early 2025, obviously already existing in San Francisco. And Shauna, earlier this week, I was there and happened to just catch one turning a corner, and you just see the wheel spinning quickly because it's turning and no person in there. I know that sounds so obvious. It's a driverless car. What else would I expect to see? But when you see it, it's like, that's weird.
It is weird. It's a little unnerving. I haven't seen one in person, but one of my good friends was just in San Francisco last week, and she actually took a ride for the first time. And she said in the beginning, she was very, very nervous, just didn't know whether or not to trust it. But then she quickly got used to it, which I thought was so interesting, because I think so many people, when they first see it, like you're talking about, it's a little bit jarring because you've never seen anything like it before. But those who I've talked to that have actually been inside of these cars have said it's actually a very pleasant experience. So I think just going based off of that, I think many people who have been hesitant maybe to get into these driverless cars really just shows the opportunity there for that and how quickly this could potentially grow as they do expand the cities that they are able to test this out in.
Yeah, 100%. I'm fascinated to see how long it takes them to get to New York. But interestingly, I want to pull up some commentary from Uber's CEO, who was speaking at the Goldman conference earlier this week in SF, saying during peak times, you could have a hybrid network that's partially autonomous and partially manned. That way we can bring it to scale all over the world. And they think it's a reason why a lot of autonomous players are choosing to work with Uber, including the leading players. So interesting that Dara is anticipating a little bit of a combination, a hybrid model where you see some manned vehicles and some that are self-driving moving forward as a way to kind of expand there.
Yeah, and also just to put this a little bit more in context, there was an analysis from Bernstein done saying that as of May of this year, Waymo's 50,000 weekly paid rides made up about 2% of the ride-sharing usage. That has actually since doubled its paid robotaxi trips to 100,000 a week, the company announced. So that really puts in perspective how quickly this is catching on, how quickly it's growing. All right, switching gears, let's turn to crypto. Michael Saylor's MicroStrategy bought more Bitcoin for $1.1 billion. The company now holding over 244,000 Bitcoins. No surprise here. MicroStrategy's Michael Saylor is a longtime Bitcoin bull. He joined Yahoo Finance a few weeks ago touting the cryptocurrency.
We're buying all the time. We're buying every quarter. We're buying the lows, the mids, the highs. You know, I'll be buying the top forever because I'm expecting Bitcoin will continue to appreciate as digital capital.
All right, no surprise here because Michael Saylor has been buying Bitcoin now for years, starting in 2020. And right now, when you take into account that he has done this in order to kind of hedge other parts of the business, a huge investor in Bitcoin, it seems like nothing is going to spook him. So we talked about the fact that every single time he comes on Yahoo Finance, I know you had the chance to speak to him recently, but he talks about the fact that he's a firm believer in Bitcoin and he's going to keep buying. So not necessarily a big surprise in the street, although we are seeing that reaction in the stock today.
Yeah, it's interesting. I was reading a note from Goldman earlier in the week about how MicroStrategy's holdings had outperformed the S&P, which is basically just saying that Bitcoin has outperformed the S&P. And so no surprise, he is a Bitcoin maximalist, continues to buy even at the top here. All right, well, finally, Salesforce touting its new autonomous agents, or as they like to call it, the next wave in artificial intelligence. Those digital assistants and its platform, Agentforce, are at the center of the company's annual Dreamforce conference this year. Akiko Fujita joins us with an early look. Hey, Akiko.
Hey there to you, Maddie. Yeah, in many ways, generative AI has already streamlined the way we work, whether it's analyzing our data or writing and summarizing our emails. But Salesforce says this Agentforce platform marks another leap from generative AI to what's known as agentic AI. So we're talking about agents that can be built and deployed and actually reason on their own. I sat down with Salesforce's AI's CEO, Clara Shai, as well as product SVP Adam Evans to get a sneak peek at this technology and why they say it's going to be driving a hybrid workforce where humans and AI agents work side by side.
What an agent is when you start to use the AI, not just for a single task, write me a sales email, summarize this call transcript, but actually an agent that can think and that can come up with a plan of action and then take action.
Those autonomous AI agents are taking shape on a new platform called Agentforce. It allows companies to build digital agents customized to their business, drawing on every piece of information on Data Cloud.
Hi, I'm Sophie, your Saks AI assistant.
Those agents then interact directly with customers.
I can come in and say something in natural language like, I haven't received my solar panels yet.
Salesforce product SVP Adam Evans walks me through a demo, pretending to be a customer of a solar panel company.
Now it's asking me about my email address.
With Evans' account verified, the agent goes to work.
And what you're going to see the agent do is now go use those actions to look me up.
Through a separate Zoom call, Evans breaks down the agent's reasoning as it retrieves the product information and explains how to set up an EV home charger. It then helps the customer set up an appointment for installation.
They can use their actions and connect to their data with those guardrails of policy in a way that's dynamic based off of what they're learning as they go, and then they can come back to the customer to help solve the problems.
The agents tackle multiple roles. A service development rep agent communicates with new buyers. A sales coach agent helps human customer service reps hone their own sales pitch and coaches them during the actual call. There's even an agent that helps develop marketing campaigns. There's no coding necessary, reducing the cost and time for deployment.
It's a much better experience for the customer because the customer can use natural language. It's not as frustrating. The old bots, we used to be a frustrating experience. It would ask us the same questions over and over again. Now these service agents from Agentforce, they really understand a wide range of human language and vernacular and can map that to what are the trusted data sources, what are the trusted workflows and business logic that it's authorized to invoke based on who is asking, and it's able to automate those actions. So it's very much here today.
In terms of what the agents that are already being deployed, there's a number of companies that are already using this, including Disney, ADP, Kaiser Permanente, as well as Open Table, Workday, Saks Fifth. You see the names on the screen there. In terms of what this means for enterprise customers, CEO Mark Benioff says agents have been able to resolve up to 70% of customer inquiries. You total all of that up, he says it's a savings of hundreds of millions of dollars for these companies. He said yesterday in talking to reporters that he hopes to have 1,000 agents ready to go out the door, deployed by the end of Dreamforce next week, guys.
Wow, rapid growth there. And Akiko, great stuff. Thanks so much for bringing us that. And of course, we look forward to any developments out of Dreamforce next week. Coming up, with monetary easing right around the corner, we're discussing opportunities within REITs, real estate. We've got that for you next on Catalyst. Interest rate sensitive REITs, also known as real estate investment trusts, are one of the sectors poised to benefit from the Fed's monetary easing in the months ahead. Already, the summer has been very good to this sector. Over the past few months, U.S. REITs have closed a performance gap with the S&P 500. Our next guest seeing potential for more outperformance. Joining us now, we want to bring in Richard Anderson, Wedbush Managing Director of Equity Research covering REITs. It's great to have you here, Richard. Talk to us about the bounce back that we've seen. Certainly some excitement ahead of the rate cuts that are expected next week, but is there more room to run?
There sure is, and thanks for having me. A part of this is kind of an instant gratification scenario where, we've seen the 10-year Treasury come in over the past few months, and the REITs, not surprisingly, have recovered ground. And so, obviously, any kind of investment vehicle with an income component like the REITs is going to do better in a declining rate environment, interest rate environment. Certainly, that sentiment isn't going that direction. We all can see that. The question is, what happens longer term? And what we'll get into in this conversation, but we're thinking about what does a better rate environment, a normal sloping rate, yield curve, do to people's attention of the fundamentals of commercial real estate, and that's really where we're thinking that the next leg of opportunity is for the U.S. REITs.
Well, let's talk about that exactly, Richard. I mean, yields have been obviously volatile, disinverting and reinverting, now disinverting again. How does the yield curve impact REITs?
The most important part of the yield curve is the 10-year for the REITs, because that's the best match with the dividend yield. But what it also does is, as we get into something of a more of a range-bound 10-year, in the range of, 3.5 to 4 or 4.5%, as long as we have some certainty about where we're going to be, then the REITs can start to, deploying capital and growing earnings through external sources. We're starting to see that happen for those that have access today, and it's certainly bleeding into the conversation. And so the short end of the curve is interesting and perhaps creates daily changes in how the REITs perform. But the real thing that we're watching is the longer end of the curve. And if we get some certainty there, then it's perhaps off to the races, and perhaps we'll have an outperformance year in 2024 from the REITs.
Yeah, Richard, I was going to ask you, and you answered right there, just how quickly you can then perform, or we could see the REITs get back to that outperformance. So let's expand a little bit on that. You touched quickly about maybe what this signals about the fundamentals, some of the behavior that we have seen from investors right now finding that reason to buy them. What does that tell us about the setup and where you are seeing the most attractive investment opportunities within REITs?
Right. So I think part of the problem here is there's perhaps a lack of understanding about what's the makeup of the REIT market. The office sector, which is the one sector that continues to be the most shorted sector in the industry, and it has its share of problems, makes up 3% of the REIT industry. So let's put that in perspective. The other 97% of the REIT industry fundamentals are actually performing quite well. And so if we can turn our attention there to industries like industrial, to industries like multifamily, even life science, if we get some recovery back there, I think shining some light on some of those real positive fundamental observations and sort of turning the page on the general thought from generalists, perhaps, that the office sector is overwhelming the space. It's just not true. So that's what we want to see.
Richard, what about, you mentioned multifamily there, and that caught my attention because we have seen a bit of a struggle in that part of commercial real estate. So what is it that I guess you think is going to turn around that momentum further? And when you're identifying those attractive spaces within multifamily, what are they?
Yeah, so right now, for someone to go out and buy a home, it remains a difficult proposition for all the obvious reasons about higher interest rates still, student loans and all of that. So people are staying in their apartments longer. You have a condition of oversupply in some areas of the country, namely the Sun Belt. But our thesis is that's a very short-term view. The supply is going to come down as soon as next year, and the stocks have performed well. It's really a consumer conversation, though. At the end of the day, how healthy is the U.S. consumer? Are we going into a recession? And will the demand side of the equation for multifamily hold up? Our call is yes. our base thesis is we won't run into a significant recession if we hit one at all. And that's why we like multifamily, because it just fits well into the whole housing continuum as we see it today.
Yeah, and following on that, Richard, if rates are falling and multifamily homes are going to have perhaps, I guess, if you're comparing it to the consumer-driven names like a Walmart, for example, if they're going to have trading in of people who typically would have been homeowners who can't be owning anymore and then they're renting, does that make it somewhat, I don't want to say recession-proof, but softer growth-proof?
Well, there is a defensive element to multifamily because one needs a roof over their head. So you could go to the mall because you want to, or you could go and do things because you want to, but you kind of have to have a roof over your head. And so there's always been that defensive side of the story. And so you have, again, what we think we got good consumer sentiment numbers today. That's a broad view of things, but generally speaking, we think the demand side of the equation for multifamily will continue to hold up. We'll continue to see flow into residents wanting a new apartment or staying in their apartments, and that just gives rise to rate growth, rental rate growth. And so that has come to fruition as we expected. We expect that story to continue in 2025, and it gets really interesting in 2026 because supply is going to be essentially gone in the Sun Belt. And if we're right on demand, then we'll be right on the stocks.
Yeah, of course. And then we've got the potential of housing stimulus to come, depending on who ends up in the White House in November. So a lot of big questions to come for the sector. Richard, we'll have to continue the conversation with you. Thanks so much for joining us. That was Richard Anderson over at Wedbush. Well, gold is trading near fresh record highs in anticipation of the Federal Reserve cutting rates next week. For the precious metal, the 25 or 50 basis point cut debate, they both spell more gains to come. With more on the commodity moves, we are joined by Yahoo Finance's Inez Ferre. Hey, Inez.
Hey, Madison. Yes, and gold touching new highs, far outperforming the rest of the markets. Let's take a look right now. We're looking at gold futures up above 2,600 per ounce. Year to date, gold is up more than 26%. Compare that to the S&P 500's up about 17% year to date. So really outperforming the markets. The fundamentals have been there for a while for gold to go higher. Central banks buying up gold, even though China has paused some of its gold buying. India has been buying quite a bit of gold. Interest rates on their way down are also sending gold higher. More investors are now expecting that the Fed may cut rates by 50 basis points next week. The ECB cut its rates again on Thursday. So that has been positive for gold because lower interest rates means that gold is more attractive to investors because it's not competing against yield-bearing assets. Now, gold has made a number of highs since around mid-April. We've seen highs here, here, here. We also have been looking at some pullbacks after those highs. So you are going to be seeing a little bit of profit taking when it comes to these peaks. So watch out for some of these pullbacks on the way higher for gold. But look, some analysts are saying 3,000 for gold, 2,700 for gold. So it's expected to go higher. And by the way, also want to mention silver up 30% year to date. Silver has also been seeing quite a big run up, guys.
Certainly have seen huge moves to the upside in both. All right, Ines, thanks. Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. Former President Donald Trump pledging to eliminate taxes on overtime pay at his rally in Tucson, Arizona. Rick Newman joining us now with the details. And Rick doing everything he can, to no surprise, to drum up support. Both sides are doing it.
Yeah, just eliminate everybody's taxes. I mean, he's kind of going through one group after another and trying to figure out whose votes he can try to grab by saying, you over there, I'll eliminate your taxes. You over there, I'll eliminate your taxes. So just to wrap up all the ones I can think of, he also wants to eliminate taxes on tips, no taxes on tips, and eliminate taxes on Social Security income. And now he says, let's eliminate taxes on overtime pay. So just to remind everybody, the president can't just get into office and do this. All of this stuff requires Congress to pass legislation. And, if there were ever some likelihood of this happening, I think it would have already happened, such as in the 2017 tax cuts that Trump signed into law. Didn't happen then. I don't think there's any likelihood this is going to happen anytime soon. But it's another, dangling bit of candy for voters to think about.
Yeah, a carrot and stick approach of a carrot that is likely to never come to fruition for either candidate, to be fair, given that gridlock that's expected. But sticking with Trump, he also made some news yesterday talking on Truth Social about how he will not be participating in another debate. Did that surprise you at all?
I'm disappointed. I wanted to see another debate. The first one was so interesting. It kind of surprised me. He's sort of waving the white flag. Trump is pretty combative. He's pretty, self-assured. Usually he thinks he can win these things. So it almost sounds like a tacit acknowledgement that he lost the first debate. He just doesn't want to tangle with Kamala Harris again. It's a gamble. He doesn't want to lose another primetime debate. But on the other hand, maybe he would have done better. So are voters going to punish him because they think he's backing out? Or are they going to say, we don't really care? I don't know. I mean, there's so many wild cards in this election. And, I keep trying to remind people this is almost certainly going to come down to very small numbers of swing voters in about 7 states who are going to decide this election. So both sides are going after every last voter they can get. And I guess Trump thinks that pulling out will help him more than it'll hurt.
All right, Rick Newman, thanks so much. Have a great weekend. Appreciate it.
Bye, guys.
Bye. Well, we saw solar stocks rallying on the heels of that presidential debate, and that's been driven by the performance of Vice President Kamala Harris on debate night, boosting investor sentiment as a potential Democratic victory is seen as favorable for the clean energy sector. But will the rally continue, and if so, which stocks are best positioned? Let's bring in Colin Rush, Oppenheimer senior analyst, for more. Colin, great to have you on. So, as we were just talking about, we're expecting gridlock to come for either potential candidate. So why did we see solar stocks rallying so much?
Well, the important thing for most industries is consistency of policy backdrops. So the volatility of any sort of incentives or market dynamics is bad for business, or at least lumpy for business. And so I think what we were seeing this week was a vote for consistency in policy. The IRA has been incredibly effective at incentivizing both demand and manufacturing in the U.S. And seeing the stocks rally is just a vote, I think, by the investors of confidence that we're not going to see much policy change as we move through and past the election later this fall.
So, Colin, then what does this tell? Just given the massive swings that we have seen within the sector's also lost a quarter of its value this year. How likely is it that some of that volatility will continue through election? And what does that ultimately tell us about the investment opportunity down the line?
Yeah, I think it's important to remember that solar is incredibly volatile, relative to almost every other sector in the, in the market. And so what I think we're seeing is one move in terms of the confidence in the policy backdrop, but we're also seeing a little bit more confidence in terms of the interest rate background. As we start to see interest rates drop, it's really the biggest lever in the capital structure for total cost of ownership, and seeing increased confidence in that cost of capital flowing through into the industry suggests that we're going to see some growth. So I think we're going to continue to see this volatility that we've always seen with the sector along a line of incremental constructive action on the stocks. In terms of top picks that we'd be looking at, we really think the domestic content, adders that are benefiting developers and asset owners like Sunrun, are going to be reflected more effectively as we get through the balance of this year and into next year. And then the manufacturing incentives are really benefiting for solar and Enphase more than anyone at this point.
I want to switch gears a little bit and talk about Tesla. In one of your notes, you talk about how on the battery side of things, SolarEdge is looking to compete with next-gen battery. How well positioned are they to be a formidable competitor to Tesla?
So there's a lot of different applications for stationary storage. Where Tesla has played has primarily been at the residential side and at the utility scale side. Enphase and SolarEdge are offering products in the residential and small commercial market. And so as SolarEdge brings their new product to market, they've been a little behind some of the other development in terms of the actual behavior that you need from those batteries in the market in terms of faster charge and discharge. And seeing them bring that product into the market early next year, I think is a net benefit for the platform as they go through some of the financial restructuring that they need to go through to really accommodate some of the market dynamic changes that we've seen in the last year and a half.
All right, Colin Rush, always great to talk to you. Thanks so much for hopping on, joining us this morning, Oppenheimer's senior analyst. Thanks, Colin. Just about an hour and 15 minutes into the trading day, let's take a look at where things stand. All three of the major averages are trading to the upside. We're seeing some leadership from the Dow, the outperformer of the three, up nearly 1%. We're looking at gains of just over 340. We'll be right back.
Let's take a look at one of our trending tickers, Paramount, announcing this morning that it will suspend its quarterly dividend, which was meant to be paid out on October 15th. Now, this comes on the heels of a lot of news that we've seen play out with the Skydance merger and Paramount. But you can see shares of Paramount Global up about 2.5% on the heels of this decision. Perhaps the idea being that anything that can help with the bottom line for the company moving forward is a sign of positive news to come when it comes to the Paramount story. But it's been interesting to see just the kind of back and forth following Paramount. Again, tons of news to pick from, but filing with the FCC, details post that deals partnership, certainly some issues with their debt profile. We're seeing them trying to get rid of some debt that they have in San Francisco. Just a lot of back and forth with the company as they try and kind of clean up the balance sheet here.
Yeah, certainly. I don't think this comes as a huge surprise. The company saying that they're doing this in order to fortify their balance sheet, try to maintain the utmost financial flexibility. You talk about the fact that they have a number of challenges out there ahead of them. So you're looking to move to the upside here of nearly 3% off the highs of the morning session. But when you take a look at that 1 month chart going back even further, Paramount, obviously a company that has been struggling, to say the least, when we talk about the competitive landscape within the sector. Now lots of uncertainty about the future of Paramount and what that would look like with the Skydance deal. So again, suspending their dividend, we are seeing a slight move to the upside here, and I think a lot of that, given the fact that it will give the company the ability to obtain or at least maintain some more flexibility when it comes to their financial future and exactly what that looks like. All right, Warner Brothers Discovery and Charter Communications reaching a new multi-year distribution deal, which will include separate Max and Discovery Plus tiers for Charter customers. Our very own Alexandra Canal joining us now with more. Allie.
Hi, so this is a deal that's very similar to the deal that Charter struck with Disney last year that really set the groundwork for what these types of deals will look like in this new streaming era. And that's exactly what this hinges on, access to those streaming tiers. Charter wants to provide its 13-some million customers the ability to have some of those streaming options without having to pay them as an add-on. They want that included in the cable bundle, and that's exactly the case here. Charter subs will receive both Max and Discovery Plus for no additional cost. Now, one of the reasons why we're seeing the stock surge so much, up 8% right now, yesterday it closed up more than 10%, is because a lot of analysts were concerned that with the loss of the NBA rights, the carriage fees that Warner Brothers receives would be less. So just to back it up here, carriage fees are the fees that pay TV providers pay to the owners of these network channels. So think WBD, think Disney, think Paramount, in order to carry those channels. So with the loss of the NBA, you think that TNT, which currently is the channel where you can watch those NBA games, it wouldn't be really a smart move for these pay TV providers to pay a lot of money to that channel. But according to the Wall Street Journal, those fees have remained flat. So that's a huge win. They didn't go down in any sense. And that's why we're seeing such a reaction in the stock price. And, you know, Warner Brothers Discovery, it's been dealing with a lot of issues, especially when it relates to its linear networks. We saw that big cable write down in the latest earnings. So this is an encouraging sign that perhaps, you know, all these different players within the media ecosystem can play nice and get along.
Well, what's next for TNT then, Allie? Because I don't know about you guys, but the only time that has been on in my vicinity is if there is a basketball game on TV. So I just worry about what that means for them.
Right.
Completely anecdotal data there, but
yeah.
Sorry.
Well, Warner Brothers Discovery is they're trying to beef up their other types of sports networks, their other types of sports rights. They're trying to grab whatever games they can, college football, to say, look, this is something that you can watch. I will say, I think the focus here is going to be on the streaming side and making sure that sports is accessible on the Max platform, which they currently are experimenting with and doing. We have Venue Sports, which is that joint venture with Disney and Fox, supposedly coming out at some point. There's that preliminary injunction. We'll see if that ever gets off the ground. But sports is certainly a big part of Warner Brothers' strategy. Even though they lost the NBA, we'll see if they can pick things back up with some of these other leagues.
So it sounds like it might be harder for you to find the games.
I know.
But they'll be there somewhere.
That's good for me. I mean, I don't want it to be on. It's just
depends how badly, Maddie, you're really trying to watch those NBA games.
All right, Allie Canal, thanks as always.
Of course.
Appreciate it. All right, we're going to take a look at a couple of trending stories we got here today. Starting with OpenAI releasing a new AI model called O1. Its previous code name was Strawberry. The new AI is part of a series of reasoning models that are trained to think and respond more like humans. So it's interesting because you kind of have this model thinking and responding a little bit more conversationally. That's what OpenAI said in a blog post about the new model, saying that, quote, it performs similarly to PhD students who are talking about challenging benchmark tasks in things like physics. And of course, it's more capable in things like coding, for example, which is really interesting. I was thinking when I read this story earlier this morning about the idea that at least when I was in high school and going into college, learning coding was kind of this hack to your career. And now I wonder, what is the next thing going to be on that end of things if AI can just code for you? Maybe it's just taking classes to learn how to use AI to code. Yeah. I know this is a tale as old as time. When you get new technology, there are questions about how it's going to change the labor force and work moving forward. But I find the impact on the coding space to be really interesting.
It is really interesting. You talk about the fact that how it's going to change and revolutionize the workforce. And I think that's one of the questions that are at the forefront of so many people's minds right now, especially if you are within that industry industry, because I think the fear with any sort of a new type of technology being introduced is exactly what it is going to eliminate. A lot of times it's that entry-level job within whatever industry could potentially be eliminated. But at the same time, you can maybe argue that it opens up some more opportunities. But going back to what this all means here for ChatGPT and Strawberry, it's a lot to be excited about. It's a little unnerving, I think, because we don't really know exactly what this is going to look like here going forward. But the company is saying that they are going to be rolling this out in stages, educational and enterprise customers gaining access next week. So again, a story to watch. United Airlines is bringing free in-flight Wi-Fi to its entire fleet through a partnership with Elon Musk's Starlink. Testing will begin in early next year. The first passenger flights with the service should take off later next year. So you're going to have to wait if you're flying on a United Airlines flight. Of course, right now it is not free. I believe it costs about $8 for a domestic flight to pay for Wi-Fi. And I think what people really want, yes, everyone loves free stuff. Obviously, that is very welcome. But I think the reliance, how reliable this Wi-Fi is going to be, because that is an issue that United has struggled with a bit in the past. I'm speaking from personal experience on their flights. So I think any sort of partnership like one with Starlink here that will improve reliability would be very welcome here for customers.
Yeah, it's interesting because it also is sort of following the heels of other airlines that have been previously offering free Wi-Fi. You have an airline like JetBlue that's offered it up for years. Delta Airlines has been offering free Wi-Fi to its higher level SkyMiles members for the past couple of years, but starting in 2023, it started being more widely available to the rest of its customers. So it's interesting given that you kind of see customers continuing to just expect the technology side of every kind of offering to be table stakes for their experience, especially when they are on a plane. But I think you were spot on, Shauna, talking about the importance of the service and the efficacy of that in-flight Wi-Fi being a really key detail for customers moving forward. All right, well, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Alexandra Canal, she's going to be filling in for Brad Smith, and she has you right here for the next hour, so stay tuned.
Welcome to Wealth. I'm Alexandra Canal in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, we're talking about the cash drag in retirement accounts. We'll reveal why so many investors are choosing to stay in cash instead of investing. And leftover money in your college savings account can now be moved tax-free to your Roth IRA. We'll lay out the details of the new law that allowed this change. Plus, mortgage rates are falling to their lowest levels in more than a year. We'll discuss how much more they need to fall to help some of those housing affordability issues. But first, let's take a look at some of the market action 90 minutes into the trading day. You're seeing green across your screen here with the Dow leading the way higher, up about 0.7% as consumer sentiment came in ahead of expectations, rising for the second month in a row. Wall Street now looks ahead to the Fed's policy meeting next week with a 50 basis point cut back on the table. Now, while the market is pricing in a near certain rate cut, inflation remains significantly above the central bank's 2% target, and there is a chance it could stay sticky in the months ahead. That further complicates the Fed's next move. Looking beyond September, what should investors keep in mind as they map out their portfolios? Here to discuss is Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager. Katie, we had this week full of data. Now the question becomes just how much the Fed will cut, 25 or 50 basis points. What do you expect? And is there too much emphasis being put on the size of this first cut?
This is a great question because honestly, it's been going back and forth. I'd say 2 or 3 weeks ago, it was 50 basis points last week. Then it was 25 earlier this week. And then now within the last day, there's been some interesting articles out in the Wall Street Journal where people are pointing to 50 for next week. So I'd say that the jury is still really out. And I do have to agree that 25 or 50, we're changing course. And when the Fed is changing course, expect a lot of things to change. And that's going to be both an opportunity and a challenge for investors.
So let's talk about some of those opportunities and the trickle effect that we could see with these rate cuts. Are there certain sectors, areas of the market that would benefit from this new low rate environment that we're supposedly about to enter?
Definitely so. I mean, so let's think about it this way. When rates go down, this is more accommodative. And so you're going to see sectors which can better borrow, would be less constrained in borrowing, that will do a little bit better. You might see some shifting from tech a little bit more to real estate, consumer staples. And we've definitely started to see this since this summer. There's definitely opportunities for rotation across sectors. So it's really about saying who's going to benefit once things change across different sectors.
Now, as we mentioned, we still have inflation above the Fed's 2% target. So there is a possibility that inflation could tick up again. So one, what are the signs that investors can look out to when it comes to whether or not we're going to see an uptick in inflation? And two, is there a way to play that in your portfolio?
Yes, this is a very important point. It's something I've been thinking about a lot recently because if you look where we are now, earlier this year, we were very worried about inflation. And we even had numbers that surprised to the negative upside for us in inflation this week. But we're still really sort of confident about a cut. And so cutting rates at the same time while inflation is still above target suggests that as things become more accommodative, that means that we might stimulate the economy and thus cause prices to go up again. So I think we're going to have to watch for the potential that inflation will go up in the future. And we need to think about sectors and areas of our portfolios and our investments that will actually be accretive during an inflationary period. Gold is a good example. Everybody's been talking about this. Take a look at that. It's continued to go up despite everything.
Yes, gold, a big commodity to watch there as we've seen prices hit record highs. Are there other sectors that you're watching? I mean, it seems counterintuitive that there are areas of this market that it's a good thing for inflation. So can you just break that down a little more?
Yeah, so we focus a lot on macro themes and different asset classes. And what we have seen is that commodity sector has been in a downward trend. So that's something to watch to see if that bottoms out, or if inflation were to come back and the economy is doing well, you might see a turn in things that are linked to inflation as commodity prices could resurge at some point. So you can take a quick look at the BCOM index, which looks at commodities. They've been down quite a bit. Energy's also been down. So things that would be impacted impacted by sort of a reversal there. And those type of cycles and moves is very interesting. We've also been looking at the dollar. The dollar has been strongly weaker in the face of cuts. So thinking a little bit about the relative valuation of things priced in dollars versus other currencies and those opportunities in relative sense globally is also important.
And we're about to enter the second half of September. September is seasonally typically a more muted stock performance month for the markets here. But what have been the best trends of September so far?
So this is a good question because there's been few trends that have been easy, particularly in the equity space. But outside of equities, fixed income has been a great trade as long as you got in before the rates moved downward so much. So I'd say that being long fixed income going into September has been the right call. I don't know what will happen next week, but also some short energy positioning has been also an interesting trade this month. So I think really sort of looking outside of the turbulence in equities, you have to look at other asset classes and other opportunities that may be sort of beneficial for your portfolio.
Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager. Thank you so much for joining us.
Thank you.
One of the options folks have when leaving a job is rolling over their 401k into an IRA. But new Vanguard research explores a costly mistake many investors may be unintentionally making, letting those rollover assets sit in cash instead of putting it back into the market. Yahoo Finance's Julie Hyman joins me now with a closer look. And Julie, why is this a trend that keeps happening? Because cash, it may not necessarily be king in this instance.
No, definitely not. At least not over the longer term, and not if you have the bulk of your assets there. As to why it keeps happening, well, that's what Vanguard was looking into. So let's say you've changed your jobs, you had a 401k at one job, you have the option of putting it into an individual retirement account or an IRA, but then you have to do other stuff. You have to allocate those assets. Why don't people do it? Why do they leave it in cash? Well, according to Vanguard, the majority, just over 2/3, said they didn't realize how the assets are invested. Then 48% say they thought the IRA assets were automatically invested. Maybe when you switch them for the 401k, you thought they were still in those same allocations. They are not. That's not how it works. Some of them do prefer cash-like investment. About 1/3. Some feel overwhelmed. There are a lot of decisions you have to make about your finances, obviously. And about 15% just said, well, never got around to it. But to sort of illustrate, perhaps what they are leaving on the table, you can just kind of simply look at a chart of the S&P 500, which, as we know, has risen over time. Now, this is a 20-year chart of the S&P. There's a lot of research that's been done that says, well, if you didn't have your money invested in the market, in different periods of time, if you tried to time the market over the past several decades, you would have missed out on the upside. Most people are not good at timing the market. And so if you have your money sitting in cash or short-term instruments that are cash-like, you are potentially missing out on having your retirement money appreciate. And what's more, again, according to Vanguard, is if you leave your money sitting for a little while, you tend to leave it sitting for a long time. In other words, if you don't do something with that cash, you don't allocate it into stocks or bonds for that matter, or anything else in the first, say, 12 months, you're more likely to not leave it there. In other words, what we're showing here is the years since rollover, and it goes out to 7 years here, how old these folks are and how they tend to sort of leave that cash sitting there. So for example here, after 12 months, 28% of investors who did this rollover still had their assets in cash or cash equivalents. And 55% of investors who made direct contributions still had their money in cash and cash equivalents. And again, if they did that, then they were likely to leave it in cash the more time went on. Inertia, I guess. We are all victims of it, Allie, but it's a good reminder. I mean, obviously, Vanguard has a vested interest in all of this. They want you investing your money, ideally with them. But, it's a fair point. You just don't want your money sitting in cash over the long term, the majority of your money. People like to have a cash allocation, but you also want to be invested and earning something on your money if you want it for retirement.
Yeah, definitely something that workers should be keeping in mind. Julie Hyman, thank you so much. With an anticipated interest rate cut coming as soon as next week, is now the right time to take some money out of your high yield savings and into longer term bonds? Our own Carrie Hannon joins us now with more. And Carrie, this seems to be a top question ahead of that interest rate decision next week from the Federal Reserve. What do you think?
Yeah, I mean, I think it's really a matter of personal preference in a way, because these high yield savings accounts, CDs, money markets, they aren't going to plummet. You know, it's going to be just a very gradual softening from the more than 5% yields we're seeing now in some places to maybe around 4%. But what it is here is this is a super opportunity to look at some bond moving into sort of high quality intermediate bonds. And for me, this would be a bond, a total bond fund usually, because there are thousands and thousands of bonds out there to do your own research on. But what happens is as interest rates drop, bond prices tend to rise. And so if you can get in before these rates start to drop, you can take advantage of this gap and sort of ride it up. This is a more, a more moderate, longer term strategy. But in fact, there are some really good opportunities for people to start looking towards bonds once again, because there have been 2 dismal years of bond prices as interest rates have been high. But as they start to come down, we will see some opportunities here. And again, most of us who have retirement plans in our 401k plans and so forth are invested in bond mutual funds. And so that's probably the way most people should think about maybe rebalancing their accounts a little bit, moving a little bit more into bonds, particularly if a sort of twitchy stock market makes you nervous.
And Carrie, I also wanted to ask about new rules that allow people to take unused 529 funds for college education and move them over to a Roth IRA. So to start here, what are 529 funds and what would be the benefit of transferring them into an IRA?
Yeah, I absolutely love this. It came out, just started this year. You could do this. 529 plans have been around for a while. It's a way for parents, grandparents, whatever, to take after-tax money and set it aside in these 529 educational funds for their children, their grandchildren. The states offer these. And the money that comes out, you invest it, the money grows. The money that comes out is tax-free. So this is a great way to pay for educational expenses. But the thing is, so many people get left with extra here. The kids have gotten scholarships or what have you, and they haven't had to use the money. You can use this money for yourself if you're a parent or a grandparent, also for your own educational expenses. They have to be qualified. It's tuition, it's fees, it's those kinds of things. And recently, or not too long ago, student loans can also be part of that. But when you switch to a Roth IRA, this is a wonderful opportunity to sock it away for some retirement, keep that money working for you. And there are some rules involved here. So you have to have had that 529 plan open for 15 years. You can't switch the funds that have been in there for less than 5 years into that you've contributed in the last 5 years into those plans. But and there will be some contribution limits. So, for example, if you're going to move from that 529 to the Roth IRA, you can't put more into the Roth IRA than currently are the limits, which is for this year $7,000. So that changes each year. But it's an interesting opportunity for, and again, this is all still being worked out. It's new this year. You'll want to talk to your tax advisor about how this is going to work for you, the individual, and whether it's a smart move. But it's really a nice opportunity for people that have leftover money in their children's 529 plans.
Yeah, very, very interesting opportunity. Carrie Hannon, thank you so much for breaking that down for us.
Thanks.
Coming up, Consumer Checkpoint. We examine recent data that shows Americans spent big in August. More on that after the break. Bank of America is out with a new report on their clients' credit and debit card spending, with the results showing a nearly 1% increase of spending in August over the last year. This comes after the data showed a year-over-year drop in July. So what's fueled last month's spending uptick? Here to help answer that question is David Tinsley, Bank of America Institute senior economist. So David, let's start there. What are folks spending their money on?
Well, mainly services. So it's mainly an experiences story. So when we dig into our data, what we're seeing is tourism, both within the US and externally, internationally, has been strong really over the last few months. Lots of action in Europe, stimulated in part by Taylor Swift, the Olympics in Paris. But domestically it's been pretty good as well. When we look at spending that people are making 500 miles away from their home, in other words, kind of like domestic tourism spending, that's been strong.
Okay, so services, a big spending uptick there. There's been increased concerns about the unemployment rate taking higher, the state of the labor market. What does this data tell us, though, about where the labor market is at today, and what does that signal, perhaps, about the health of the consumer?
I think it signals in our data. So what we're seeing is when we look at the wages going into people's bank accounts, we're seeing for the lower income, that's up about 4% year on year, and for the higher income households, it's pulled up a little bit. It's about 1% year on year. So the labour market is cooling for sure. I think the official data shows that. But there's still, in a sense, wind behind the sails of the consumer for now, at least.
Can that continue?
Well, I think it can continue for the foreseeable future. I mean, clearly, you know, the the jobs data showed a pullback. If that continues, eventually you'll see some softening in wages. But I think that, and the other thing I think is worth mentioning, is that people still have this kind of cash buffer in their accounts relative to 2019 before the pandemic. So that helps them feel a little bit more confident about spending as well.
So what are some of the biggest risks that could perhaps stop the wind in the sails for these consumers? You mentioned unemployment, but are there other things that could potentially derail?
Yeah, the labour market's the obvious one. But the other thing we're pointing at in the checkpoint this week, and, you know, we're looking at these sort of 69 million customers the bank has, and we're looking at their auto payments in part in this checkpoint, and we're seeing, you know, if you did buy a car, lots of people didn't, but if you did buy a car over the last few years and finance that on these quite high rates of interest on the car financing rates, you are likely to see quite a steep auto payment rise. I think about 10% of people who pay their car loans are seeing a rise of about $400 or more relative to 2022. So if the economy does go south, those people might struggle a little bit in terms of financing the cash to keep those loan payments going, or alternatively, they have to pull back a bit on spending in order to make room for them.
And I want to dig in a little deeper about how this all breaks down demographically, really. You mentioned this bifurcation between lower income, higher income consumer. What about generationally as well?
Yeah, that's interesting. So what we've seen in our data for quite a long period of time, really, is it's actually the older generations who've been doing better than the younger generations in terms of spending. And for a time, that story was about the fact that they got these quite large cost of living increases for their social security retirement incomes. That's not quite so true now, but it's still the case that there is a bit of a divergence with the older gens basically outspending.
Got it. And we talked a lot about the jobs market, but the inflation story, it's another one that we are consistently discussing. But we have seen sticky areas of inflation like shelter. But I did think it was interesting that in this report, there's evidence of a slowdown in housing cost inflation. So what are you seeing there?
Yeah, that's interesting. So what we do in this report is we look at when people move apartment, their rents before and after, keep them in the same city in the study group to make sure we're not conflating people's cost of living choices. What we're seeing is that those rents before and after a move are pretty much flat. They're pretty much zero. So in other words, while shelter inflation in the CPI has been quite sticky and persistent, and, you know, the Fed is worried about that somewhat, we're seeing some signs that rent inflation will come down as a result of that softening in the market.
Yeah, I think that would be welcoming news for a lot of folks out there. But David Tinsley, Bank of America Institute senior economist, thank you so much for this insight.
Thank you.
Appreciate it. Much more on wealth after the break. You're watching Yahoo Finance. buying a home has become more affordable compared to 1 year ago, according to new data from Redfin. Let's bring in Yahoo Finance's Danny Romero with a closer look.
Allie, good news for buyers. Redfin found that the median monthly mortgage payment reached around $2,500 during the last 4 weeks ending in September. Now, that is a 1.3% decline from last year. Now, a big help here has been the decline in mortgage rates. The average rate on the 30-year fixed mortgage fell to 6.2% this week. Freddie Mac reported mortgage rates have been falling more than 0.5% point over the past 6 weeks as investors really expect a rate cut from the Federal Reserve. They actually hit their lowest level since February of last year. Still, home prices haven't really come down from their highs. The median sales price is 3.7% higher on a yearly basis. Now, home prices remain elevated due to the lack of supply. Plus, buyers are expecting that rates will move even lower after the Fed eases monetary policy, which is keeping a lid on sales activity. Allie?
Well, Danny, what about the activity in the second home market? What are you seeing there?
The appetite for second homes has fallen. It's down 13% on a yearly basis, according to Redfin. Mortgage demand remains very sluggish across the board due to high home prices and elevated mortgage rates. Now, Redfin found that the demand for second homes remains especially low due to several factors. One, mortgage rates are double from what they were during the pandemic. Two, second homes are more expensive. And three, employers are asking workers to return to the office, so people are spending less time at a vacation home. Allie?
Danny, thank you so much for that. Well, housing payments may be getting more affordable, but don't expect rates to fall much more. Our next guest says lenders have already priced in future Fed rate cuts. Joining us now is Jennifer Beeston. She is the Senior Vice President of Mortgage Lending at Rate. Rate is a mortgage company that offers a variety of mortgage products, personal loans, and insurance. So, Jennifer, let's start there. You say a lot of this has been priced in. Does that mean whatever we see next week, whether it's a 25 basis point cut or a 50 basis point cut, is that not going to move the needle at all with mortgage rates?
So what you need to take into consideration is that right now people are expecting a 25 basis point cut. If that happens, I don't expect rates to change from where they are right now. If we saw a 50 cut, I would expect them to go down further. But what's interesting is that rates don't just follow the Fed. Rates have come down so much since last year, and I don't feel like Americans know that.
So how much has the mortgage rate fallen over the last year, like you just said, and how much more is that saving people when it comes to a tangible monetary amount?
Right. So I took some notes. So like October 2023, we were at about 7.8 on a 30-year fixed. Now we're at 6.25. So if you think about the average home price in America, and look, some markets are way more than this, and some are lower, but the average price is about $500K. If you look at October to now, we're talking about $520 a month in savings. That's huge. That's changes how much people can qualify for, but most importantly, if they're comfortable. And that's what we're looking at a lot right now is, are you comfortable?
So given all that, you say it's time now to look at refinancing options for people who, quote, dated the rate and married the house. But is there an ideal time to refinance, especially if the Fed, if that holds up, the expectations hold up, that they continue to cut rates through the end of the year? Should folks wait?
Look, it depends on your individual situation. So like I would talk to a loan officer right now. I've been chatting with a lot of my clients, and what we've been talking about is, hey, I can save you 1%, 1.5%. Like government loans have dropped so much, VA, FHA, that we're seeing these huge savings. And then it's up to the borrower. Does it make sense now, or do I want to gamble and leave money on the table? Because with the election coming up, there's a gamble, there's uncertainty. Even though the Fed's saying we think we're going to be cutting rates, who knows what's going to happen in November? So
right, and how does that TBD factor of the election play into the mortgage rate story and really the housing story at large?
I think that, well, look, you have some people that are waiting until the presidential election to go shopping. You have other people that are waiting to see what pans out because there's such different housing policies. So I think right now we're in a really good moment where rates are great, and I think as we get closer to the election, we're going to see more and more volatility.
So I know there's no crystal ball when it comes to how low rates could potentially go, but is there a magic number of sorts that if we hit that, we might see more demand, more uptick in activity?
Yeah, so I think that most people expect that when you see that 30-year at about 5.5, you're going to see people get really, really excited. I would argue that where we are now is really interesting just because even in October of 2023, people were buying houses. So I think the best advice for people who are thinking about buying a house, you can't time the market. If you could, we would all be doing that. So see what works best for you, see what payment you're comfortable with, and see if you find a house you like. Don't wait for the election, don't wait for a magic time, a magic day, or a magic number, because it's going to depend on your individual situation.
And I also wanted to get your thoughts on the new buyer-broker agreement. It seems like folks are a bit uneasy about this change. So can you explain why this is still a negotiation at the end of the day?
Yeah, so there's a lot of buyers that are worried that, well, if I can't pay a real estate agent, I can't buy a house. So now I have to save for a down payment, closing costs, and the real estate agent. But what I'm seeing across the country is that real estate agents can negotiate with the seller for their commission. Will you get every house? No, but you're not necessarily going to get every house anyways. It depends on what you offer. It all comes down to the net price. So interview the agents, make sure they're taking their time to go through this with you. Do not give up your dream of home ownership. Everything's a negotiation.
Everything's a negotiation. That's really important. And then I want to leave you on this because we've talked a lot about mortgage rates, but there's also this issue of supply in the market, and that's pushing prices higher across the board. So what else does this industry really need to see that bounce back in activity?
Ooh, that's a big question.
Yeah.
And look, it's market by market. So it's like if I think about Texas is very pro-builder. So we don't see that lack of inventory in Dallas or Houston. But then you have areas like New Jersey. New Jersey stayed very competitive. It's going to depend on the market, but realistically, you need two things. You need Americans to be able to buy houses before corporations. And then you also do need to have in areas where there has been restrictions on building, you do need some building. And there's some great ideas out there. Like I like the concept of office space that's not being used, being turned into housing. That's a great idea. So I think we all just have to talk about it and work together to get some more supply for people.
Got it. Well, there's a lot to keep in mind, and we'll see what happens as we head closer to that election in November, as you were discussing. But Jennifer Beeston, thank you so much. She is a Senior Vice President of Mortgage Lending at Rate. Appreciate it.
Thank you.
Americans have a record $32 trillion in home equity as of the first quarter of 2024. That's according to the St. Louis Fed. But let's back up and talk about what that actually means. Home equity is the appraised value of your property minus the amount you still owe on your mortgage. So let's say the value of your home is $500,000 and you owe $100,000 on your mortgage. You have $400,000 of equity. And you can actually tap into this equity in order to pay for other things. So it's essentially a way to get cash at an often lower rate than personal loans or credit cards. So let's talk about 3 different ways that you can do this according to Bankrate. 1 is a home equity loan, 2 is a home equity line of credit, and 3 is a cash out refinance. First up, home equity loans. Now, these are second mortgages typically set at a higher rate than your first. It's for a fixed amount at a fixed rate over a set period of time, typically over 20 years. This could be a good option if you own a large portion of the home outright and you need to cover the cost of a big ticket expense. Meanwhile, a home equity line of credit is more like a balance of a credit card. You get approved for a set amount of credit, but you do not need to borrow all of it. This could allow you to fund a long-term project or higher education costs. Now, with this option, interest rates do vary with the prime rate, though some lenders will allow you to set a portion of it at a fixed rate. Finally, a cash out refinance. Now, this replaces your current mortgage by refinancing for more than the outstanding balance, and you can take the difference out in cash. This can be an option if you can get a lower or comparable rate to your current one and you need extra cash for a single large expense. Coming up, are you having trouble sticking to a budget? Our next guest has some tips for you. That's next on Wealth. Creating a budget may seem like a tough task, but sticking to it can be even harder. Here are some tips and tricks to keep you on track is Michaela Alaka. She's a founder of Break Your Budget. Michaela, it ain't easy to budget, but what should be the first step if you are really starting this journey?
Totally. I always say that budgeting and financial success is 10% strategy and 90% behavior. So once you've created your first budget, the next highest priority is to start implementing some financial routines. So what is a financial routine? I say to start with a weekly money review. What does this mean? It means you're taking 10 minutes every week to not only review the budget that you set, so that means tracking your expenses and looking at how you stack up, but also taking a few minutes to make some adjustments because sometimes things change, life happens, that's totally normal. And a lot of us will walk away from a budget the second that something goes awry or away from the plan. So 10 minutes a week to track your expenses, look at what's going on and make adjustments is one of the most important things you can do to be successful.
So what about when you're struggling to stick with a plan? Because I know sometimes it happens to me, life events occur, I end up spending a bit more that month. So when you want to get back on track, what should you really be thinking about?
Yeah, that goes back to the third step of like a weekly money routine, and that's making adjustments. So I like to shift dollars around within my budget. Let's say that, I budgeted $300 for groceries and $200 for going out to eat. And I went out to eat and I had a big meal with my friends and I really enjoyed it. And I know maybe I'll spend a little bit less money on my groceries. I'll just make some shifts. I'll make those adjustments because as we said, life happens and it's totally fine if you overspend in one area, if you're able to make some adjustments in other areas to align with that.
And what's the biggest budgeting mistake that you often see people make?
Yeah, I think one of the biggest budgeting mistakes that people make is creating a budget and then never looking at it again. That's a big one. And also not being realistic with what you're truly going to spend. When you're creating a budget, it's perfectly normal and honestly pretty common to be really idealistic about how you want your spending to be in a perfect ideal state. But life isn't perfect. Things don't always go exactly perfectly to plan. And it's totally okay to be realistic about what you're actually going to spend because if you don't, you really are setting yourself up not only to be disappointed, but also to not reach your goals.
And how should your budgeting plan differ depending on your age and your goals? Because if you're older, you might have a different budget than someone who's younger, just getting out of school or starting a new job.
Absolutely. So I recommend that people follow what's called a zero-based 3-bucket budget. And this basically allocates every dollar of income you're earning towards either an essential expense, a financial goal, or a non-essential expense. So the financial goal piece of that really is important depending on how old you are and what your goals are. So if you're earlier on in your career, maybe you're not making as much money, you might not have as much room for your financial goals, or your financial priorities might look a little bit different compared to if you're older, maybe you have a little bit more income to work with in an ideal state. And you also could be prioritizing investing or drawing down money from your retirement. So it really depends on what those goals are and how much wiggle room you have in your budget. But when you follow that strategy, you can get super clear on how much money you have to work with for not only your goals, but your non-essentials so that you can balance the both and actually enjoy your life.
Michaela, I want to pivot to some career advice that you have. You suggest a 30, 60, 90-day plan that you created for someone who starts a new job. Can you break that down for us?
Absolutely. So a 30, 60, 90-day plan is a roadmap for you to really establish expectations and responsibilities at the beginning of a new job. But it can also be used if you're looking to pivot into a different type of job or you're gunning for a promotion or something. So what this means is within the first 30 days of being at work, you are taking time to really educate yourself and get acclimated not only to the company culture, but to your team, to start building those relationships, really understand the scope of your responsibility, because maybe you got a taste of that in the interview, but you don't really know, right, until you actually start the job. It's also a great time to take some trainings, get all set up, and really get situated in this new role. The next 30 days, so by 60 days on the job, the goal is to start contributing. So this means that you are becoming an active participant on your team. Maybe you're able to start taking on some projects or tasks with less oversight. You don't have to tap your manager on the shoulder for everything, and you're starting to take a little bit more initiative. And then by 90 days, so the next 30 days thereafter, you are initiating. That means you're fully ramped up to your job. You're starting to think a little bit longer term. Maybe you're implementing some new strategies or looking at processes that can be improved. And you are a full-blown participant on that team. You have, all of your responsibilities are up to speed. How that looks is obviously going to depend on the type of job you have. That ramp up period could be a little bit faster, could be a little bit slower. It's individual, but it's a really great guideline to start with if you are starting a new job and maybe your manager doesn't hand you, you need to do 1, 2, 3 on the first day of work.
Michaela Alaka, Break Your Budget founder, thank you so much for those tips. Appreciate it.
Thanks for having me.
Coming up after the break, another episode of Stocks in Translation. I spoke with Roth Capital Partners chief economist and macro strategist Michael Darda. That's next. Welcome to Stocks in Translation, Yahoo Finance's latest vodcast that cuts through the noisy numbers, the jargon, the hyperbole, the mayhem to help you make the best decisions for your portfolio. I'm joined as always by our all-star producer, Sydney Freed, and I'm very excited that Michael Darda is also joining us today. He is the chief economist and macro strategist at Roth. Hi, Sid. Hi, Michael. Thank you so much for joining the show today.
Thanks for having me on.
And we have a fun topic to talk about. It's something that I feel like investors, it's been on the minds of a lot of traders out there for the past, several years, I would say, and that is recession. It is our theme of the week. One of the scary economic possibilities that could happen, especially with the unemployment rate rising, the Fed weighing its next interest rate decision. That brings us to the word of the day, which is volatility. Safe to say, September, not a great start for stocks. S&P 500 dropping more than 2% to kick off the month's first day of trading. What has investors so concerned? This is a key question that we're going to be tackling today. And this episode is also brought to you by the number 34. That's the number of U.S. recessions since 1857, according to the National Bureau of Economic Research, otherwise known as the NBER. But let's get to it with the theme of the week. And Michael, we said it, stocks not doing so hot to kick off the month. S&P 500 dropping about 2%, the worst drop since 2015. Heightened concerns that the tech bubble is bursting. We mentioned the unemployment rate. Just so many things going on right now. What's your big picture view when it comes to where the economy is heading?
Sure. Well, I think taken into context, we're getting a bit of a pullback here after essentially a 2-year straight up equity market. Okay, so going back to 2022, we had a pretty bad market year that year with the S&P down 25%. So it's just been a rocket ship since the fall of 2022. And, we went almost a year without a 2% pullback until the volatility started in the middle of July of this year. So this is actually more normal than what we were dealing with before. And there are questions about the economy and the business cycle, stock market valuation. So what's unfolding now actually makes a lot of sense to me.
Are investors being a little dramatic by, bringing around the recession word when it's clear from other indicators that we still have like a strong economy in many ways? Is it dramatic?
Well, the recession word does tend to come up pretty frequently, and it tends to come up when you get equity market volatility. And so it was pretty interesting in that this pullback that that started in mid-July and then reversed until just this week set off alarm bells about the Fed being behind the curve, maybe should do 75 basis points intermeeting before the actual formal meeting on the 18th.
That seemed a bit dramatic
right?
at the time.
I kind of wanted it to happen, by the way, just for the drama.
Just for the drama, just for the plot.
So yeah, completely dramatic in the context of the consensus view before the volatility storm hit this summer was soft landing, smooth sailing. And so I think what ends up happening is the R word is sort of thrown out there anytime the stock market starts to stumble. And we saw that writ large in 2022. And we actually had 2 down quarters of GDP in the first half of 2022 and a bad stock market year. And we were fighting this argument the entire year that, a recession, people assume it's 2 down quarters of GDP. That usually happens, but not always. We've had recessions where there are non-consecutive down quarters, but in every single case, you see a rising unemployment rate, and that was not what was taking place in 2022. But for us, we try to be consistent, and so that year looked a lot different than what we're dealing with now, which is been this incredibly robust equity market, but some cracks in the business cycle foundation. It has been a soft landing for 13 months since the Fed stopped raising interest rates, but that's not unprecedented to have a slowdown period that looks like a soft landing and then a recession ends up taking shape. And it's sort of unexpected now because I think many have been lulled into this idea that the soft landing is sort of going to be a permanent state of affairs for the business cycle, and that equity market valuations reflected that coming into the summer. So I think we're skating on ice here that's a bit thinner than a lot of people presume. So
back it up. What is a soft landing?
Okay, yeah, absolutely. So the idea of a soft landing is that after a period where the economy is growing above trend, and if you're coming out of recession or you're coming out of this huge slump in 2020 with the COVID shock, you need to have above trend growth for a while to get the unemployment rate to come down to normal levels. But too much of a good thing means high inflation, right? So with the economy booming coming out of 2020, we got a 2-year period of elevated inflation. So the Fed's goal with the rate hikes, raising short-term interest rates 530 basis points, the goal wasn't to topple the economy. The goal was to slow demand in a way where supply could catch up and inflation would come down. The Fed knew that would create a risk of recession, but that wasn't the goal in and of itself. The soft landing is simply you go from above trend growth to growth that is in line with potential or trend, meaning the sum of productivity growth and growth in the working age population. And that would be a balanced economy where inflation is about at the Fed's target, but low and steady.
Let's get to that dual mandate of the Fed, right? You were talking about inflation. Obviously, that's the goal of the Fed to bring inflation down, but they also want to protect the jobs market. And we have seen that rise in the unemployment rate, 4.3%. You say that that's an important trend for investors to watch.
Right.
Why? Why is that so important?
So with the unemployment rate, it's not just the level, which, 4.3%. Historically, that's very low. I mean, that would be defined as full employment. So things look pretty healthy from that perspective. But the change in the level, the trajectory, really tells us a lot about what's happening in the business cycle. When the unemployment rate is falling, the economy is usually growing above trend, sort of the definition, so slack is diminishing. If you're growing below trend or below the growth rate of potential, then slack is increasing, the unemployment rate is going up. And usually that involves an actual contraction in the economy. So we haven't seen that yet, at least in the published figures. I mean, GDP growth has still been positive, but the unemployment rate has been creeping up from the cyclical trough in the fall of last year. In January and April, we bottomed out at 3.4%. So we're almost a full percentage point off of the lows of the cycle. And if you go back and look at all the business cycles since the end of World War II, for which we have data, any kind of a rise like that over a similar period has involved a recession starting. And just, year over year, if you take like a 12-month change, we're up 0.8 of a percentage point. Literally unprecedented outside of the end of a business cycle, start of a recession. Now, jobs are still positive, GDP is still positive. So the question is, okay, well, maybe the unemployment rate is just wrong this time. It's a little dangerous because we know that job growth, which comes from a separate survey of establishments, sometimes is positive into the first few months of recession. And in fact, we had one recession, which was a bad one, 1973-75, where payroll growth actually was positive for 9 months after the business cycle peaked. And that was also, a very overheated labor market, a high inflation period going into that recession. GDP growth ends up revised dramatically at business cycle turning points. There was a great chart floating around a few weeks ago that showed the 6 revisions to first quarter GDP in 2001, the first quarter of recession. And we went from 2%, the initial estimate, to a final estimate of minus 1.3. The unemployment rate really isn't revised. So I think if we have concerns that we might be at a turning point, it makes sense to take the unemployment rate data at face value, and that is a bit concerning. And this is really where the debate is. Why is it rising? Is it okay because the labor force is growing fast, or we have this impulse from immigration? Is it a benign rise this time? And, some of the arguments are with payrolls positive and GDP positive, don't worry about it. And I'm not completely sold on that argument.
Who do you trust? How often, 2 questions. How often does any specific data point, is it wrong and it has to be dramatically changed? And then 2, can you define, well, go with that first, then I'll do my second question.
Yeah, I think unfortunately, the government agencies do the best job that they can do, but they're not working with complete data sets. Everyone wants the information quickly, but when initial estimates come out, they don't even have complete data for something like GDP. And so the first estimate is simply incomplete. They do the best that they can. Response rates post-pandemic have been really low for a lot of these surveys. So unfortunately, we are sort of flying blind to some degree. And this is where I think you probably want to lean a little bit more on some of the survey-based data. And we can look at...
So what's an example of that?
Well, it would be, an example of that would be the ISM manufacturing index data that we got this week for August, or the Conference Board confidence measures that also have some subcomponents that track the labor market. And we can look at those series and ask the question, does this look similar to GDP and job growth and earnings estimates, or does it look really different?
Is 4.3% itself a bad unemployment rate?
No.
What's a bad unemployment rate?
Yeah, I think if Fed Chair Powell was here, he would say, we want the lowest unemployment rate feasible, but with price stability, right? So if we could temporarily drive the unemployment rate down to 2% or 1%, but the cost is a big surge of inflation, that's not a sustainable environment. And so, what the Fed can do is to try to create an environment of price stability where we have that in expectations and in terms of the data that's coming in, and then the unemployment rate finds its level. And the hope is that, it would be historically low. 4.3% on a historical basis is actually quite low. So if you go back to the decade decade of the 80s or the 90s, even a lot of the 2000s. I mean, that's an incredibly low unemployment rate level that looks quite good in the historical context. The problem, if there's a problem, I do think there's a little bit of a problem, is that we're up to 4.3 from a cyclical trough of 3.4. Those kinds of movements in the level tell us that the economy, if it's still growing, is growing below trend, below the growth rate of potential. There's an exceptionally fine line between that and an actual contraction recession. They do happen. Recessions on average happen about every 5 years. We've had a few business cycles that have been 8 to 10 years long. And they typically happen after a period where the Fed has raised short-term interest rates quite a bit, which
we've seen
just occurred. So.
That was part of my conversation with Michael Darda, Roth Capital Partners chief economist and macro strategist, on Yahoo Finance's Stocks in Translation podcast. You can catch the full episode on YouTube and everywhere that you see your favorite podcasts. Well, that's it for Wealth. I'm Alexandra Canal. Thank you so much for joining, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern. You won't want to miss it.